In this video, I'm going to show you how I would start my day trading career over again if I had to start from the very beginning. And before getting to a point where my trading was my sole income and I was able to make $5, $10, and even $20,000 of profit in a singular day, I realized I wasted thousands of hours and most importantly, thousands of dollars being confused when I started off, because boy, did I need that money back then. And the worst part is it could have all been avoided had I had known the information that I'm going to share with you in this video. Now, this is not going to be a regular YouTube video, which is going to be super short, but instead it's going to be a long one, and I will give you everything you need to know about day trading and how to get started. From how to get started, the tools you're going to need, how to excel using those tools. Then I will give you my step-by-step strategy and a breakdown of that with the rules and everything you need. And this strategy I have been gatekeeping for years. Then I'm going to give you a step-by-step breakdown of technical analysis so you can look at a chart and know what is going on. I know you're likely overwhelmed when you look at a chart and there's just so much information. By the end of this YouTube video, you will know everything there is to know about a chart, and you will have a step-by-step proven strategy that I've been trading for years and have been also gatekeeping for years. I do not want a lot of people to know about this, but since this video is a breakdown of everything, I will show you everything and give you my strategy for free. All I ask is that you pay attention, because if you do exactly that and you apply yourself, you do not need to watch a day trading video ever again. This can be the first and the last video that you watch in your day trading journey. I will give you the exact formula that you'll need to scale your accounts to get to a point where you're making 20K days like it's nothing. And by the end of this video, you're gonna know me so well to the point that you might as well be invited to the cookout and my wedding. So hit me up on Instagram for the invite. But it's only for people that actually watch this video and pay attention and also take notes and apply themselves, because if you fail to do that, don't even try hitting me up. I'm being dead ass. Do not hit me up. Now, before we get started, I feel like it's important for you guys to know my backstory and how I got into the position I am right now. And here it is. How I went from minus 50% days and being very, very familiar with this account successfully liquidated screen. I hate this with my core, to making $7,000, $8,000, $12,000, $10,000, $23,000 in a singular day. Now, at 19 years old, I was a sales rep just trying to make some money, and I was also getting into some reselling, right? I was reselling some shoes, anything hype, right? Because that's what was trending back in the day. And during that time, I saw a YouTube video that really intrigued me. I don't know if you guys know about this YouTube video either. I guess not, because you guys are getting started with this. But 7 years ago, this video came out with this guy right here. His name is Ricky Gutierrez, and he is who introduced day trading to me. I saw this video and I was like, holy crap, you can make $11,000 in a singular day. I want to do this. I didn't even know if I was able to do this, and now I'm in the same position as this guy right here, making those same 5-figure P&L days like they're nothing. So I started getting into day trading. I was trading some small caps and instantly got hooked from this YouTube video, but you know, lo and behold, it didn't do too well because I was down to my last $20, and it wasn't amazing, but I think it was a pivotal moment for me. And I'm happy that this happened because I scaled an account up, I was making some money, and then boom, lost it all again. So I'm like, what am I doing that is wrong? Because this is just all red. Daily P&L all red, not a single green instrument right here. So I'm like, I need to switch something up. I know that this is something I can succeed in because I have seen the potential in it. Then I started getting into crypto a little bit. I don't know if you guys know about SafeMoon. That is the OG meme coin that started it all. But lo and behold, I lost all that as well. And then I was like, you know what? I'm going to stop trying to treat this like it's a hobby, like a side hustle, and instead treat it like a business. Start taking this seriously and try to scale this as high as I possibly can, right? And in 2022, I purchased my first futures funded account, and then 5-figure days just became very, very regular to me. And I think from this journey, a lot of it can be avoided, which you can benefit from. This video is mainly for my younger self, and I wish someone had made a video like this because I would have saved thousands of hours and dollars. And I don't want any of you guys to go through the same journey that I went through right here, because you guys are just seeing pictures right here. You guys aren't seeing what was happening in real time and seeing literally this right here, losing 50% of your account, not a funded account, not a demo account, not an evaluation, but your actual money, losing that in real time and saying, all right, I ain't tripping, this just wasn't meant for me. All right, hold up. This video is to save you from the darkest portion of your day trading career, which I do not want any of you guys to have. Now, I hate YouTube videos that take 10 hours to get to the point, so here it is. Why should you start day trading? This is not a video to sell you on day trading and tell you why it's better than dropshipping or Amazon FBA or real estate, whatever. Because if I have to sell it to you, then that means that you're already very indecisive about it. And if you're indecisive about it, you're likely going to quit. And if you're likely going to quit, I'm not going to waste my time wasting my breath on that. Now, why most people fail in day trading? And we have a 98% failure rate. And also how to make sure you're not part of that statistic and you are a 2% winner. The reason people fail is they have a lack of education and they fail to prepare. They don't have the proper technical analysis or even resources to even have an edge in the market. And also they don't journal. They don't do anything outside of trading. They just click a couple buttons thinking that it's going to make them money. But in reality, that's not the case. With this, I'm going to give you that education and make sure you are prepared when you start day trading, because you are fighting against billion, trillion dollar industries and hedge funds and companies. If you think yourself with $8,000, $10,000, $20,000, $50,000, or even $100,000 is going to make a difference, you are cooked. If you come into this industry with an ego, the market will welcome you with open arms. I'm being so dead ass, and take every single penny that you have. This is the reality of day trading. You need to be properly educated and be prepared for every single outcome that can occur. And in this video, I'm going to teach you that. Another reason why people fail is they have poor risk management. And I'm going to give you a masterclass on risk management and how I view risk and how to manage everything to the point where risk management in itself can become an edge. Some people have an unprofitable strategy, but they can still be profitable if their risk management is an edge of itself. Now, what is an edge, you may ask? It's something that puts you ahead of the competition. 99% of people have this information and you have it a second faster. That itself is an edge because you can execute onto that and make money from that. Another reason why people fail is they are very emotional. And in this video, I'm also going to give you a psychology breakdown on how you cannot be emotional in trading. It's very, very hard to get to this point, but it is doable. Another reason is that they are undercapitalized. And if you are in this position, that doesn't mean that day trading is not for you. Even if you are undercapitalized, you can still make money day trading. How do you do so? You use other people's capital to propel you and make money through that. And I will show you how you can do that in this video. Another reason is that they have no trading plan. And this shouldn't really be an issue to anyone watching this video, because if you watch it to the end, you will have my step-by-step breakdown strategy. So this should not be an issue. Another reason is that they are impatient and have unrealistic expectations. This just goes back to emotional trading, and they have that psychology block within them. And in this video, I will be giving a psychology lesson to make sure you are part of that 2% that actually succeed instead of that 98% that fail. Now, if you are watching this video and you don't know which statistic you're going to be a part of, it's very, very easy. The easiest way to tell if you are going to be a part of the 98% that fail or the 2% that succeed is if you watch this video to the end and you take notes and you apply yourself, you're likely part of the 2%. But if you watch a quarter way, 1/10, and you get bored very, very quickly and you have to scroll through Instagram Reels or TikTok or even YouTube Shorts, who the hell scrolls through YouTube Shorts? I don't know. But if you are one of those people that needs that dopamine hit instantly, sorry, you're likely part of the 98%. I'm not going to sugarcoat it just so you can feel better in this video. I deadass couldn't care less about that. This is to make sure that the 2% that do watch this video and they have that proper plan and pathway to success, they actually achieve it. That's the biggest sign that you'll actually make it in this industry. Now, the tools you're going to need starting off are TradingView, a brokerage, and a journal. What is TradingView? Now, TradingView.com is going to be what you use for analysis literally majority of your trading career. I have been using this from the start till now, and I've been trading for almost 5 years now. It's going to be 5 in November. Damn, I'm getting old. So what you do is you hover over products and click on super charts, and this is what you're going to see starting off. They also have a desktop app, so I'm going to switch over to that right here. So with TradingView, you're getting access to the data that occurs in the market. This is all price fluctuation right here, and it might be hard for you to read, so you can look at a line chart to determine how price is moving. But I would highly recommend you look at candlestick charts. If you're starting off from the very beginning, this can be very, very overwhelming. So I will give you everything you need to know. What you're looking at right here is a candlestick. It consists of a low, an open, a close, and a high. This encapsulates one time increment. Now, this time increment can be 5 minutes, 1 hour, 1 day, 1 week, 1 month. It could even be 1 minute, right? But it tells you what the price of the asset was when we opened during that day. For example, the low that was created during that day, for example, the high that was created during that day, and what the price closed at during that day. Now, this entire thing right here, the colored part of your candle is called a body. The outside literal lines right here, they're called wicks. This shows how much price has moved during a time increment. So let's say the bottom is $100 and the top is $110. We have a 10-point range inside this entire candle. The open can be 103, for example. So let's say this is a weekly candle. The open is Monday, the close is Friday. We opened at $103, went down on the week to $100, and that's the lowest the price was during that week. Then we started to move higher and we went to $110 right here, and then we went into Friday and we closed at $107. That is what a candle is. And if it is green, it shows that the price moved higher during that candle. If it is red, it shows that the price moved lower during that candle. So for example, let's go to Bitcoin. If we are on the 4-hour chart, each candle represents a 4-hour range. So let's look at this high and this low. Let me make this a little bit thicker for you guys. So boom, and boom. The highest price point of this 4-hour candle was $112,924, and the lowest price point of this 4-hour candle was $111,877. Moves and how it closes and how the candlesticks actually look give you a different framework and portrait. Think of this entire thing as a portrait. Each candle is a brushstroke, and it is trying to paint a picture. Your job as a trader is to determine what picture is being painted. For example, if you look at this picture right here and you think to yourself, what is this board talking about? This is just a picture of some bricks. You're not looking closely enough. If you look closer, you will notice that there is a cigar inside these bricks. This is exactly like day trading. Something can be hidden in plain sight. You might not be able to see it the first time you look at it, but when someone outlines it and you know what to look for, it's very, very easy to spot what you are looking at. And now that you know that there is a cigar on this, if we go back to the original picture, you cannot unsee this cigar. You probably couldn't see this 30 seconds ago. Just because you can't identify something doesn't mean it's not there. And our job as traders is to identify what the market is telling us and what the portrait and the brushstrokes mean and what the picture is painting. Now, if we zoom in on candlesticks right here, we can see that different candlestick formations give you different context right here. So a doji is when the price opens at a certain point, it moves higher and then moves lower and then closes back at that certain point. This basically means that there is a lot of indecisiveness in the marketplace. Each candle right here gives you a different story on what you are looking at. For example, this Dragonfly Doji, we open at this price point right here, we move lower and then move back up. This is telling us that when price moved lower, a lot of sellers came into the marketplace, but buyers were still aggressive and started moving the price higher. What does that mean? These sellers are now underwater, which can likely mean we continue higher and it is a potential reversal signal. Vice versa for a gravestone doji, but to the downside. A hammer is literally the same thing as this, but just more confluence. An inverted hammer kind of signifies weakness, basically telling us that we open at this price point right here, we move higher, but then sellers came in aggressively, moving the price lower right here, but not to the point where it is a gravestone doji right here. So it's not as weak as a gravestone doji, but still weak. Hanging man is the opposite thing of an inverted hammer, and the bullish and bearish spinning tops are basically dojis, kind of telling us that there is a lot of indecisiveness in the marketplace. This bullish, I don't even know what the hell to call this. Like, I've been trading 5 years, I've never heard this name, but it's basically when we open and there's barely any sellers, indicating that there is a lot of buyers in the marketplace. And this is just the opposite, and there is a lot of sellers in the marketplace. I'm not going to go through every single one of these, so make sure you screenshot this and take notes and also review this, because this is something you should definitely learn. Now that we know what candlesticks are, we can kind of paint a better picture. And the best pictures are painted during certain sessions. What do I mean by this? We have 3 main sessions when it comes to the market: Asia session, London session, and New York session. Asia session is the least volatile session out of all of these because there's not a lot of volume. This doesn't mean that there aren't any moves. Sometimes there are movements during Asia session, but I would not recommend you trade during these sessions unless you cannot trade during New York or London. London is the second biggest session, and it goes from 3 a.m. to 12 p.m. And then the most important session is New York with the most volume, which I highly recommend you trade in because the most amount of moves occur during New York session. And that is from 8:30 a.m. to 4 p.m. Eastern Standard Time. All of these are in Eastern Standard Time. Now, the reason the volatility during these sessions is low is because the volume during these sessions is low. There are not a lot of market participants during Asia and London session, which is why I don't really recommend you trade them if you are a beginner starting off. It really depends on which asset you're trying to trade. A lot of people will say you should only be trading New York session, but that's not always the case. If you're trading Forex, ideally you should be trading London session. So Forex right here. If you're trading gold, if you're trading metals, ideally you should be trading Asia session, so metals. If you're trading indices, you should be trading New York session. So you should determine which asset class you're trading and trade the session which has the most volume on that asset class. We can see on gold, for example, the highest volume is usually during Asia session and London session. On Forex, majority of Forex traders are in the UK and overseas, so they're primarily trading London session. For indices, we're trading US stocks, which trade under the New York Stock Exchange, so New York session is going to have the most volume for those indices. Now, if you're trading DAX, for example, it would be 9:30 a.m., whichever time is 9:30 a.m. in Germany. So your homework right now should be to find what you want to trade, and then once you have decided that, you should trade the session that has the highest volume. For example, right here, let's go to gold right here, XAU USD. We can go on the hourly chart and look at the volatility right here. When are we most volatile? Are we volatile during New York session or during Asia session or London session? Like, for example, we can see this huge move to the upside. When did it happen? It happened from 9 p.m. to basically 11 p.m. What does it line up with? Asia session, right? So we can see, okay, gold is moving kind of decently during Asia session. What does it do during New York session? Literally still the same thing, 9 a.m., not much movement. And we can kind of denounce that gold should be traded during Asia session and a little bit during London, not so much during New York. And the lowest probability setups are likely going to occur during New York. Highest probability setups will occur during Asia. If you do not have this on the bottom of your chart right here, go to indicators on the top right here, search up volume, and it would be right here, and it should be literally just volume right there. Right? And it'll give you all the volume that you are looking at and give you the times where the highest volume is occurring. You want to be trading with volume compared to against volume. The thing with candlesticks is that they don't tell you volume. They don't tell you how many participants are in the marketplace during a certain time. Now, if there's not a lot of volume in the marketplace, there's not going to be a lot of movement, most likely. For example, we can see that this huge move to the upside right here is with volume. This move to the upside right here is with volume. When we have low volume, for example, right here, barely any volume, what occurs? Barely any movement. So you should accompany volume with movement, and you want to be trading during the times where there is movement, because you don't want to be in a trade for 10 years, for example. Now, it seems like I forgot to mention how volume works, and there are probably some people that don't know. So here it is. It's basically one transaction that takes place. For example, let's say you are Jimmy, smiling, you chilling, and you're selling watermelons. And then Tyrone over here wants to buy a watermelon from you. When Tyrone buys one watermelon from you, that means one transaction took place and 1 unit of volume occurred. If he buys 5 watermelons, that means 5 units of volume occurred. And this goes back to day trading, because it doesn't matter if only one transaction occurred. If Tyrone buys 100 watermelons, that's a fairly large order. That gives you substantial information on how watermelon pricing is moving, because when demand increases and someone is buying 100 watermelons at a time, that can tell you that watermelons are probably cheap, and prices of the watermelon should go higher to meet that demand that has increased. Now, there are some times where volume waits for things. For example, news. If there is a highly anticipated news event that wants to drop, think of it as a roadblock for volume coming in. Once that news event occurs, that roadblock and traffic clears up and volume is able to pour into the marketplace freely. A lot of people are likely waiting for that news event. If it's super highly anticipated, they're likely waiting for that to drop, because they don't want to be placing positions with a lot of uncertainty in the marketplace. Ideally, you want to be placing a position when you know that it's likely going to go higher or it's likely going to go lower. Now, the best website for determining every single news event that is going to occur is forexfactory.com. And this is what you're going to see starting off. And the filters you should be using are this button right here, click filter. Expected impact is basically red is high impact news events, orange is medium impact, yellow is low impact, and gray is basically holidays and times where the market is closed, right? So I would highly recommend you to not have low impact news events, because this is just a lot of nonsense. You only want your high impact news events, because that is what actually moves the market. Now, for currencies, it should be whatever you're trading. If you're trading AUD, USD, for example, then you should have AUD and USD. If you're trading only indices, then I would recommend you only have USD enabled, like I do. Apply filter, and this is what you should be seeing right here. With this, we can see when the news event will drop, and when it does drop, it also gives you the numbers on what they actually are. So you can also be on side of that move. So if you trade fundamentally and you look at news and you need this data to give you a insight on what decision you should make, if you should long or if you should short, this right here also gives you the data, and it'll give you your insight that you need. Now, you're probably very curious on what you should be trading and what you can trade, and it goes back to the sessions right here. Now, there are multiple assets that you can trade with forex, futures, stocks, options, and crypto. I primarily trade futures, and I have traded every single one of these. Why I would recommend futures over everything else is with crypto, it works, but there's just way too much unregulation and like scammy behavior. There's so many scams and bad behavior in crypto, so I kind of stay away from that. Options, I hate options with a passion. Fuck Greeks, fuck the gamma, delta, vega, theta, screw theta, and rho, screw all the Greeks with a passion. Stocks, I would only say you should trade stocks if you're trading with like 2 million plus, or if you want to trade individual names. Sometimes individual names have better personalities than the entire market, so you can go towards that. Now with stocks, you can be trading small caps or large caps. If you're trading small caps, it doesn't really matter, like you can trade it. It's just you're going to have to do way too much analysis. When I was trading small cap stocks, I was waking up early in the morning, literally waking up at like 4 a.m. trying to see what the gap up or what news dropped, and also having to do pre-market analysis on a new stock basically every single day because there's a new runner and you have to see the news on that if you want to short it or long it, blah, blah, blah. It was just way too much. And if you are looking to trade large caps, I would say you need like 2 million plus to get into that, which is why I really, really recommend futures, because the barrier of entry is very, very small and you can make millions doing this if you have the proper education and you know what you're doing. Forex I've traded as well, but I would still say futures is on top because you can trade Forex contracts on futures. For example, the euro dollar, there is a futures contract for that. The biggest Forex pairs have futures contracts. So you can trade that under a regulated market compared to unregulated Forex brokers that have manipulated spreads and have literally been proven to trade against you when you take a position, which is very, very unethical. They make money when their clients lose money. With futures, this isn't the case because it is fully regulated. The way brokers make money is through commissions and how you should be making money, not trading against the people that use your broker. The Forex space is so messed up, and I would highly recommend you don't even touch that with the 10-foot pole. Now, there's a few trusted brokers out there. AMP, Tradeovate/NinjaTrader, Interactive Brokers, TradeStation, and Webull. With futures, we have margin requirements. This basically means you need a certain amount of money in your account to open up a contract. Depending on the asset you're trying to trade, the margin requirement is going to be different. Now, we're going to be looking at ES and NQ, which is the S&P 500 and the NASDAQ 100. These are the two biggest assets when trading futures, and it is what I would recommend for you to trade. For ES and NQ on AMP, both are $400 a margin, which means you need $400 in your account for one contract to stay open. Let's say you have $1,000 in your account. You need $400 for one contract to stay open. So you have $600 of wiggle room in that position, which means if you go down $600 and your account balance goes under $400 for a nanosecond, your position will be liquidated, which basically means you will be forced out of your position because you no longer have the required amount for one contract to stay open. Now, each contract is $400. Because you have $1,000 in your account, you can have two contracts open, which will make your margin $800 and you only having $200 of wiggle room in that position until you're liquidated. Now, this is for day trading, which basically means you can buy and sell that within a single day, and that's how much margin you need during that day. If you are looking to hold a position overnight into the next day, you'll need $11,000 for an ES contract and $17,000 for an NQ contract. For NinjaTrader, we have 500 and 500 for ES and NQ, and the same overnight margins. Interactive Brokers is way more costly with 16,000 of day trading margin on ES and NQ, and also overnight margin. Now, you might be looking at this thinking, why should I trade with Interactive Brokers? The thing with Interactive Brokers is that they are very, very reputable. If you have an account size of 50 million, for example, you'd want to go with Interactive Brokers, and you're probably not watching this video if you have 50 million. But when you get to that point, you'd want to be trading with Interactive Brokers because they are very reputable, and a lot of large, very large account sizes trade under Interactive Brokers. Now, with TradeStation, we have 1,600 for ES, 1,000 for NQ. For the overnight margin, it's usually the same across every single broker because the exchange itself sets that overnight margin. The broker doesn't set that. That basically means the overnight margin is out of the broker's control unless they want to add on top of that. So 11,000 is the minimum, and if they want to add on top of that like 10,000, they can, like Interactive does with 16,000, but they don't have to. Now, when trading futures, there is a larger contract and a smaller contract. The larger one is called minis. The smaller one is called micros. On the S&P 500, when price fluctuates $1, which is basically 1 point on the contract, it is a $50 movement in your P&L. If you are trading the micro contract, it is 1/10 of that. So it is $5 instead of $50. On the NASDAQ 100, $1 of price fluctuation is $20 of P&L fluctuation on your account. And on the micro contract, it is $2 per contract. Now, the margins we were talking about earlier are 1/10 on MES and also 1/10 on MNQ. So if you don't have a large enough account size to trade the bigger contract, or if you just don't want to trade the bigger contracts because you don't feel comfortable with a $20 price fluctuation per dollar, then you can also trade the micros. So you get one, a feel for everything, and also two, you are more confident on a position if you have a wider stop loss, blah, blah, blah. But basically everything is 1/10 of the value on the micro contracts compared to the mini contracts. Now let's start talking about the technical analysis aspect of this entire video, which is likely going to be one of the longest. So our first lesson is going to be market structure. So you know what, let me put highs and lows first, because you should understand that way before you can understand market structure, right? Now, highs and lows are basically literally that. When the market moves higher, then starts to move lower, that high that was created is called a high, right? If we start moving higher, we don't have a high yet if it's just moving higher, right? The market needs to move lower for a high to be created, and the same exact thing for a low to be created. The market needs to move lower and then higher for a low to be created. So we can draw out this price fluctuation right here. Where is a high and where's a low? So we can see that the market moved lower and then moved higher. Boom, that's a low. The market moved higher and then moved lower. That's a high, right? And then there's a low. There's a high, there's a low, there's a high, there's a low, there's a high. And then we can see that we're starting to move higher again. That's a low. Okay? Very, very simple. This aspect is a very easy one to learn. So let's look at it on a candlestick chart instead of me drawing it out, right? So let's get rid of everything. Where is a high and where is a low? Okay? So we can see that, okay, the market moved higher and then we moved lower. What is that? A high. So we can mark that out. Boom. The market moved lower and then moved higher. What is that? That's a low. We can mark that out. The market moved higher and then moved lower. What is that? That's a high. And then the market moved lower and then moved higher. That's a low. Same thing. Moved higher, then moved lower. That's a high. Moved lower and then moved higher. That's a low. Moved lower, then moved higher. That's a low. Then moved higher and a little bit lower. What is this? A high. Calculating highs and lows is very, very easy. So let's do another example. I'm going to close my eyes and look at it. Boom. Now, identifying highs and lows should be very, very easy. The only way for you to, I guess, find them instantaneously is through practice. When you start off, it is going to be hard. You will have to look for it, but you will get to a position where you can see them very, very quickly, right? Now, let's find out highs and lows right here. So we can see that the market moved lower and then moved higher. What is this? A low. Moved higher, then moved lower. This is a high, right? Moved higher than lower. This is a high. Moved higher than lower. This is a high. Moved lower than higher. Low. This is a low. Move lower than higher, low, move lower than higher. This is a low, right? We can very, very easily see moved lower than higher. What did we do? Made a low. Moved higher than lower. Boom, high, low, high, low, high. What is this? Low, high, low, high, low, right? And then made another low right here because we made a low, move higher. Made a low, move higher. High, high, low, high, low, high, low. All right? And this is identifying highs and lows. Now, if it is very difficult for you to identify these highs and lows, here is a cheat code. Go to the indicators section right here. So this is going to be the button where we have all the indicators. Click on that and search up swing highs and lows. Click on the one from Pattern Smart right here. When I apply this onto my chart, we can literally see every single high and low that I marked is also marked by this indicator. So starting off, this is what you should use to identify these swing highs and lows efficiently. If you really struggle with this, you can just have this on your chart forever. I'm going to be honest. You don't have to be able to identify this, because if the indicator can do something that you can't, you don't have to try to figure out something that you can't do. You can literally just let the indicator do all the heavy lifting, and then you just look at it and you're like, that's a low, that's a high, nice. Now that you know how to identify highs and lows, we can look at market structure. Market structure is basically telling us what the trend of the market is, right? If we are moving higher, that's a uptrend. If we are moving lower, that's a downtrend. To identify a uptrend and a downtrend, it is very simple. You use the lesson that you just learned on highs and lows. First, what you do is you mark out your highs and lows. So we have a move higher than lower, so that's a high, low, high, low, high, low. And then we have a low right here, a high right here, low, high, low, high, low. Now to identify a trend and market structure, you use these highs and lows and you look for a high and then a high above that high, which is called a higher high. When a higher high occurs, that tells you that, hey, we moved higher in the marketplace. Now, the next thing you will look for is a low that is higher than the previous low, which is a higher low. In this scenario, we have a higher high and also a higher low. When that occurs multiple times, we are in an uptrend. So we can see that we have a high right here and a high right here. So this high is higher than this high. What does that mean? We created a higher high. We have a low right here and we have a low lower than this. So this low is higher than this. What does that mean? We created a higher low. So let me just mark these out. So high right here, low right here, higher high, higher low, higher high, higher low, and then higher high again. And we don't have a low created. How do we know this? Because we need to go down for us to create a low. Now let's look at a downtrend. It will be the same exact thing, but just flipped upside down. We have a low created and then a high created. We need a low that is lower than the previous low. So we can see that a low is created right here. A high is created right here. This low right here is lower than this low right here. What is that? A lower low. This high right here is lower than this high right here. What is this? A lower high. Okay. This low right here is lower than this low, lower low. This high right here is lower than this high. What is this? Lower high. This low right here is lower than this low, lower low. When we have multiple lower lows and lower highs in a row, that signifies a downtrend. Now let's look at it on a chart. So we can mark highs and lows and find out the market structure. So we have a low right here, high right here, low right here, high right here, low right here, high, low, high, low, high, low. So in this scenario, what do we have? We have a low, we have a high. Okay. What do we have here? A higher low. And then we have a higher high. Boom. So what does this mean? We are in an uptrend. Boom. We have a higher low right here. And then we also have a higher high right here. And then a higher low. And then a higher high. Whoops. And then a higher low. And then a higher high. And then a higher low. And then a higher high. And then a higher low. And then we take out this low and then create a higher high. So this is market structure. And this is how you will identify a trend higher or lower. Now, Mo, what happens when we are going sideways, for example, right? We will do these price signatures. We will create a low, a high, a lower low, and a higher high, right? So we have a low, and then we have a high, and then we're going to create a higher high, and then we're also going to create a lower low. This tells us that we are trendless because we can go back to our notes right here. For a trend to establish, we need higher high and higher low, or lower low, lower high. If we are getting a lower low and a higher high, that tells us that there is no trend in the market right now. This is what is called trendless behavior, and these markets are the hardest to trade when they are trendless, and the easiest market and the best money is made when we are trending. You want to identify trending conditions and position yourself on those conditions. Learn how to identify uptrends and downtrends very, very easily. Now, I want you to pause this video and do a 5-minute homework. I want you to identify uptrends and downtrends. You should be able to identify a uptrend and a downtrend very, very easily. And I want you to build that muscle in your brain to see this without even looking at the highs and lows. So I can get rid of all these annotations and you should still be able to see, okay, that's a low, that's a high, that's a higher low, that's a higher high, right? And you should be able to identify, boom, uptrend, boom, downtrend, very, very easily just by looking at a chart. And that is your homework right now. Pause the video and look at a chart, go to TradingView and do it on your own chart. Now that we know what an uptrend and a downtrend is, what starts an uptrend and a downtrend? That is called a break of structure. So let's say we are trendless right here. We are going and creating lower low, higher high, lower low, lower high, higher low, higher high. It's really just trendless. What causes us to have a break in the structure? We need to start and create a higher high and then a higher low, or a lower low and a lower high. And we have to do that like once or twice for us to determine that, hey, this is an actual confirmed break of structure instead of us just like doing some BS, right? So you might see this price fluctuation a lot. What you do is you wait for the market to create a what? Higher high or a higher low, right? Or a lower low and a lower high. So in this scenario, boom, let's say we go higher and create a higher high. We move lower. We move higher again and we move lower. What is this? So we have a low, high, low, high, higher. So we have a low, high, higher low, higher high, which tells us that this is a valid break of structure and the trend is now to the upside. And then we can also look at the same exact thing to the downside. Once we break, go higher and then break again, go higher and break again. We have a low, high, low, high, low, high. Let's mark our higher highs and higher lows. So we have a low, high, lower low, lower high, lower low, lower high, right? And once we have this lower low and then lower high and lower low again, and then also a lower high, that tells us that, hey, trend is now to the downside. And once we have a low, high, and then once we establish that trend, that is what is called a break of structure. Where did we break the structure? Right here? We can see that we have this structure established. We have lows and highs. We broke the structure right as we broke under this low, creating a lower low and also a lower high. This fully confirmed this downtrend, and this is also a full break of structure as well. So now that you know what a break of structure is, let's do some examples. We have a high, low, lower high, lower low, lower high, lower low, higher high, lower low. What does this mean? Trendless. We break this high, create a higher high, higher low, higher high, higher low. When do we start an uptrend? Where is our break of structure? Right here, once we break this high right here, and this confirms a higher high, a higher low, and this fully confirms a shift in trend. Now let's do an example for the downside. So we have a high, low, lower high, lower low, higher high. So we're trendless. Boom, break this, lower low, lower high, lower low. Once we fully break this right here, that tells us that we are in a downtrend. Boom, we start moving lower right here, and then lower low, and higher high, lower high. And once we break this high, that tells us that a uptrend has started now, right? So it's really just price goes lower in a trend. Once it meets a level, we react off the level, and then we trend higher. And once we meet a level over here, over here, then we start moving lower. And then, yeah, that's really the premise of how the market moves, right? It's always moving in a trend higher or lower. Even if we are trendless on higher time frames, on lower time frames, there is a trend higher and lower, and we're continuously moving in cycles of an uptrend to a downtrend to an uptrend to a downtrend. If it is chopping right here, for example, right? This might be, let's say, an hourly chart, right? We're chopping, we're really not doing anything, and it's going sideways. But let's zoom in right here, for example, and let's say this is a 1 minute chart for this move higher. What are we doing on that 1 minute chart? We're moving higher, high, low, higher high, higher low, higher high, higher low, right? So on the lower time frame, we have an uptrend. On the higher time frame, we're just doing nothing. We're going sideways. So it's really just doing a trend up to a trend down and just switching every single time, right? So it is very important for you to understand this concept, and that is how you identify market structure. And now that you know what a break of structure is, you have laid out the foundation of what your trading will build upon. We are now going to be talking about the most important concept throughout this entire video, which is liquidity. This is what moves the market higher and lower. Let's say the market is moving right here. For every buyer, there needs to be a seller. So if I need a large buy position or a large sell position to get established, I need a large amount of orders to fill my buy or sell position. So let's say you are Tyrone right here and you're trying to buy 1 million watermelons. Now, if you buy 1 million watermelons, the price of watermelons are going to skyrocket. So what you really want is for the prices to plummet. You buy up 1 million watermelons and make the price go higher. How do you do that? So what you do is, you know, Darnell right here and Tyrese and let's say Tyrone right here all have 300,000 watermelons. You want to buy up all their watermelons, but you can't do that so significantly. So what you do is you manipulate Darnell, Tyrese, and Tyrone into thinking that the prices of watermelon is going to plummet. With this, they're going to want to sell their watermelons naturally because they don't want to lose out on their money. So when the market goes lower and prices are going lower, for every buyer, there needs to be a seller. Your ass buys up all the watermelon that they're selling. So now you have 1 million watermelon and you bought down here because this position was where the most amount of sellers were in the marketplace, and boom, you move it higher. Now liquidity is where the most amount of resting orders are. For example, let's say we are in a range. If you are trading this range, you are shorting the top and buying the bottom. Where are you placing your stop loss and where's your thesis invalidated? Under these lows right here. So you place your stop loss above this high and under these lows. Liquidity is finding out where the most probable area of interest is and finding out where people place their stop loss orders for the market to hunt those stop loss orders and then reverse in the opposite direction. For example, let's say we go lower and we go higher right here. This down here is a liquidity sweep. Why is that? For every buyer, there needs to be a seller. So in the market maker's eyes, they can't buy in the middle of this range right here, because if they do buy, they're going to move the price up drastically. So what they want to do is they want to be buying when everyone else is selling. So they manipulate people into thinking that the market is going lower and we're breaking down below this range right here. And they buy up all their stock inventory right here. And then the price truly starts moving higher because they've actually accumulated their position. Now, when you're thinking about liquidity, always think about how the market makers are going to enter into the marketplace, right? They can't really enter into this range because, you know, these guys are playing with billions and trillions of dollars. If they enter into a position, that's going to drastically move the market. So what they want to do is they need a high point of interest, and for every buyer there needs to be a seller. They need to have a lot of sellers for them to be a buyer, and they need to have a lot of buyers for them to be a seller. The easiest point of interest where majority of people are sellers is under these lows, and the easiest point of interest where everyone is a buyer is above these highs. Let's do a chart example. We have this range right here, right? For us to fully move higher to this high right here, what do we need? We need that liquidity sweep, and we need to break below this range. So we can draw out our line under this low, and then we can see that right as we take out this low, what do? We have buying activity and then a move higher. Now, one biggest thing with liquidity is a large move higher or lower cannot occur until large money is in the marketplace. So there needs to be a liquidity sweep for us to move higher. For example, we are moving lower and then we move higher right here. We should, in theory, because we have a trend higher, move higher to this high right here. But we're not doing that. Why is that? We have not taken out liquidity yet. So let's mark out this low right here and drag it through time. And we can see if we zoom in that that line right here was us sweeping that low, which is that liquidity sweep. We barely traded under that low, and then we aggressively moved higher. And right after taking out that low over here, which is that liquidity, we had a proper move to the upside. The best forms of liquidity are previous day high and previous day low, session highs and session lows, and then previous week high, previous week low, and also previous monthly high and previous monthly low. Okay, so when I say PMH, that's previous month high. When I say PDH, it's previous day high. I usually never say it, but if I write out PDH, think of it as previous day high and previous day low, and yeah, right? So that's what the strongest liquidity levels are, because for us to move higher or lower, we need to trade into that level. So you can do two things. You can either take a trade to that level, knowing that the market cannot go higher until we go lower first and take out liquidity. So for example, if you have a liquidity level marked, let's say right here, you can trade the market to that level down here. So let's say you want to enter into a short position, you can enter into shorts down here to that liquidity level, or you can look for longs after that liquidity has been swept, and you know, okay, we have confirmed that this is that liquidity sweep. We have buying pressure and large money is in the marketplace now. Since large money is in the marketplace, we're likely going to reverse. We have that full confirmation that we are reversing, and then you take your position to the upside. So let's do some examples and let's look right here. So we have this consolidation range. We are not doing anything at all. And before moving lower right here and this huge move lower, what do? We have that liquidity sweep. So we take out this session high and also previous day high, and then right as we take it out, we instantly reverse, indicating that large money is in the marketplace and we have a higher probability of continuing lower, right? This is a liquidity sweep 101. So you can take a trade to this liquidity level, or after we've confirmed downside, then you take a trade to the downside. Let's do another example. We can see that we're going lower. We have a retrace. People think, hey, this is the bottom. We should move higher. What do? We sweep out liquidity. Boom. Buyers are into the marketplace. And what do we do right after that? Uppity, right? And then we really don't even trade back into that level for a while. And that is what a liquidity sweep is. Let's do another example. We have this daily low right here. We have a large move lower, taking out this daily low, and then boom, move higher. It's almost as if it was manipulated by the market to have you selling down here, thinking that, oh snap, we're going lower. Like, imagine this. Let's go into replay right here. Let's go back one bar. If you see this candle right here, you see this huge dump candle. You look at this and you're like, holy crap, we have aggressive selling pressure. I want to short, we're likely going lower, right? That's what the market wants you to think. And let's say you're also in a long position from here. You get stopped out under this low, If not under this low, or wherever your stop loss is, you get stopped out of your long position and you think, hey, we're likely going to go lower. Let me go short, right? And what happens? Reversal, right? This is how the market manipulates you, and this is how the market moves. It needs to manipulate you for it to go higher or lower. Like I said, for every buyer, there needs to be a seller. And if you are a seller in a certain area, just before you click the button, think about, how would I be moving if I was a buyer here? We swept this liquidity. Everyone else is a seller here. And because we know that 98% of people lose in this industry, let's just do the exact opposite of what the 98% are doing. What are they doing? They're probably selling down here. They're getting stopped out of their positions down here. You know what we should do? Probably be buying, right? Now let's talk about relatively equal highs and lows, right? These are known as very, very strong liquidity points. So let's try to find a relatively equal high that price wants to trade into. So we can see that right here, we have these two highs right here. We can see that we have these two failure highs right here. Because we have relatively equal highs, there is a lot of liquidity above us, indicating that any move to the downside is a higher chance of being a sweep of liquidity for us to continue higher, right? Think of this relatively equal high as a magnet, and any move lower is so large positions can get established to go higher to that magnet. So you want to be looking for trades when we have that liquidity sweep in the direction of the magnet, right? So let me just draw a magnet right here. Boom. Because we have that magnet right here, we know that price will likely gravitate towards that magnet. What do we want to do with our confluences? We want to be looking for liquidity sweeps to the downside to target this magnet right here. So what happens? We move lower, take out this low, and what is this? It's a daily low right here. We can say Friday, July 18th. It is that low, and then on Monday, July 22nd, we take out Friday's low and then move higher. What do? Let's mark this magnet out. We have even more liquidity getting engineered. Boom, boom, boom. Any move to the downside, what is that? That is a chance for you to get onside towards this magnet right here. And this pullback right here, what is this? It is for us to retrace to continue higher towards this magnet, right? Any shorts that is entering in right here is going to get smoked because we have this magnet to the upside. And this would be the same exact thing to the downside. Let's look at this example right here. So we have these two lows, this low and then this low. They are very, very close to each other. What do? We consolidate. You can see that we're going higher, right? But we don't truly move higher with aggressiveness until we take that liquidity out. We sweep under these lows. We can see that, boom, large buy positions are established. And what do? We have a large, very large move to the upside. This is what liquidity is about. And this is how you can put yourself on side of the market with large players. You want to be trading with the large money instead of against it. And the best way to do so is use this liquidity to your advantage and position yourself on side with them. Shout out every single person that looked at this, saw that we're going lower, and anticipated a continuation lower. Cooked. Now let's start talking about fair value gaps, imbalances, and inefficiencies. They're all basically the same thing. So whenever someone says FVG or inefficiency or imbalance, they're talking about this. So a fair value gap is a 3-candle concept, right? So the first candle is a semi-consolidation candle. The second candle is largely engulfing the first one and creates some sort of gap. The third candle fully confirms that gap. So in this sequence, we have this third candle not trading into the top of the first candle, right? And then the second candle, the body of it overlaps the top of the first candle's high and overlaps the bottom of the third candle's low. This is what creates the fair value gap, right? And that is in a bullish setting. In a bearish setting, it is the exact same thing, but it looks for some different things. So we look at the first candle's low, and then the third candle's high. When the body of the second candle engulfs the first candle's low, and then the third candle does not trade into the first candle's low, a bearish fair value gap is created. Now, these fair value gaps are key points of interest for the market to head towards. The market seeks out liquidity to the upside when it trades into an external liquidity, or it trades into internal liquidity, which is a fair value gap, right? When we trade into an internal liquidity, let's say this is a daily candle, we take out a previous daily low, right? When we take out this previous daily low, we trade into this daily fair value gap. This is what is called an internal liquidity sweep. When we move higher and we trade into the high of the pullback, that is called an external liquidity sweep. So fair value gaps are very important because they are used for price to trade back into and used as support or resistance, right? Because we can see by the second candle right here, because of how strong it was, there was a very, very strong imbalance of buyers and sellers in this 3 candle pattern, right? Which is why it's called a imbalance. When there is an imbalance of buyers and sellers, the market tends to trade into that level and then go higher off of that. And then vice versa, trade into that level and then lower off of that for a bearish scenario. Now, I want you to screenshot this and engrave this 3 candle pattern into your brain, because you should be able to see this as fast as you can identify market structure, as fast as you can identify liquidity, as fast as everything, because you will be using this a lot. So let's do some chart examples. We will look for fair value gaps that price traded into, respected, and continued higher off of, right? So in this scenario, we can see, okay, where is our 3 candle pattern? Okay, let's look for 3 candles. We have 1 candle right here, second candle right here, and then the third candle right there. Okay, so we can mark it out. So let's do 1, 2, and 3. Okay, so first candle right here, boom, second candle right there, and then the third candle right there. Okay, we can see that the top of the first candle did not trade into the bottom of the third candle, and we can also see the body of the second candle engulfs the top of the first candle, and then the third candle, the bottom of it, we don't trade into the top of the first one. So what we do is we draw a box from the top of the first candle to the bottom of the third candle, right? Now, if it is very, very hard for you to identify these fair value gaps, you can also add an FVG indicator just by going on FVG. Nephew Sam seems to be the best one, right? And then it draws it automatically right here. Okay, I want you guys to practice drawing them though, because you should be able to identify this without an indicator. If it is very, very hard for you, then you can add the indicator, but I really recommend you have the indicator for a very short period of time, just like that high and low indicator that you probably added and you probably are not using anymore. So we can see that price traded into the fair value gap, we filled this fair value gap, and what happened? We moved higher off of it, right? Let's do another scenario. We can see a 3 candle pattern. So we have 1, 2, 3. I don't know why it's doing that. 3, right? Where is the top of the first candle? Right there. Boom. Let's mark it out. Let me make it a bit thicker, right? The body of the second candle engulfs the top of the first. Okay. The third candle, the bottom of it, does not trade into the top of the first one. What do? We draw our box from the top of the first to the bottom of the third. Extend it. Boom. We can see that price traded into it, respected it, and continued higher, right? Now, how do we know that price is respecting a fair value gap or not? The easiest way to determine this is if the body does not close outside of the fair value gap. Okay? What do I mean by this? So we can see that the wicks right here are trading into the fair value gap, but the bodies are not closing, 1, inside of it, and 2, outside of it. When we fail to close even inside of the fair value gap, that is a sign of large strength in that direction, right? So we can see in this scenario, we fail to close even inside this fair value gap by the body, and we only wick into it and then move higher, right? In this scenario as well, we fail to even close inside this fair value gap. We only wick into it and then move higher. Let's see another one right here. What do we look for? 1, 2, 3. So let's put this on 2. put this on, whoops, put this on 3. All right, so this is the first, this is the second, this is the third. Okay, what do we look for? The top of the first, the body of the second engulfs the top of the first. Nice. The bottom of the third does not trade into the top of the first. Boom. Mark it out. What happens right here? We fail to close inside of this daily fair value gap, indicating large strength to the upside. Now let's do a bear scenario. We can see 3 candles right here. This one, the second one down here, and the third one down here. All right. So what are we looking for? The bottom of the first, okay? The body of the second engulfs the bottom of the first. Nice, okay? And then the top of the third does not trade into the bottom of the first, okay? So when that occurs, we take the bottom of the first to the top of the third, extend in time, boom. We trade into this fair value gap and trade away from it, moving lower right here, right? Now, there are 3 levels to look out for when trading a fair value gap. The first tap of it, so the very bottom of it, let me get rid of these annotations. The first tap of it, the 50% of it, and then the fill of it. So the first tap of it is the top of the third candle, and then the 50% of it is 50% of the box that you've created. And then the fill of it is the bottom of the first. How are you able to find 50% of the box? Just double click on your box rectangle and make sure middle line is on. Okay? And we click OK. That's what you have. So when price trades into that level and we have a reaction off of those levels, that tells you that, hey, we are reacting off this fair value gap. And if we don't have a reaction off those levels, that tells you, hey, we're not reacting off this fair value gap, and there's a chance that we go in the opposite direction, right? Let's do some more examples. Now let's combine some stuff together. What do we have? We have this range right here. We have liquidity above. We sweep that liquidity and instantly move lower, okay? With your lesson, you know that, okay, that's potentially a liquidity sweep. Now you should be looking for downside trades, right? We start to move lower. What happens? We create a fair value gap. 1, 2, 3, boom. Bearish fair value gap. And we can see that price trades into this fair value gap and then starts to move lower. Where is it most likely to head towards? Our next draw on liquidity, right? Where is that? It would be session lows or low of day or previous day low, right? Like I talked about before. Where is that? We can see that, okay, where is our low of day? We have this as our low of day. What does this also line up with? 1 low, 2 low, 3 low. 3 stacked lows, indicating that, what is it? If you said anything aside from magnet, then you're cooked. But it is a magnet for price to trade into, and boom, we trade into that perfectly, bounce off of it, and then move lower, continuing, and then, yeah, and then we move higher. So your trade over here, no, not yet, my bad. You should not be taking a trade yet because you're learning technical analysis and how the markets work, and then I'm gonna give you my strategy on what to look for using all this to basically trade off of, right? So we trade into this fair value gap right here, boom, and then move lower to our magnet, draw on liquidity, right? This is when you combine the fair value gap with drawn liquidity together and you have a sexy ass opportunity. Now that you know what the market is doing, what levels to react off of, and where it's heading towards, you need an entry criteria, right? Don't worry. All right, we're gonna get into that. Don't worry. Now these imbalances are very, very strong levels of interest. You can see that if there is a liquidity sweep lining up with a fair value gap, that is a very, very high point of interest, right? So for example, right here, we can see that we have low of day marked out right here. Let me just mark it out right here. The low of the day is right here. What is underneath low of day? Fair value gap, boom. Okay. And also another fair value gap right here, down here. Okay, let's play how the market reacts to these levels, right? Boom, we trade into low of day. What else do we trade into? 50% of that fair value gap. What happens? We react off of it. Boom, boom, ba-da-ba, boom, pow, right? And we continue moving higher off of that. And that's literally the low. This is when you start incorporating multiple things to form a thesis. And then you can see that, okay, the brush strokes are saying, okay, accumulation, manipulation into this level, distribution, which is also just liquidity sweep. We have this accumulation. What occurs during this accumulation? Liquidity is engineered because they need the market to sweep out liquidity for them to establish their positions higher or lower. And then what happens when their positions are established? Let's see. Boom. All right. Now, let's say you entered in right off that liquidity sweep. You would have been down $20, 20 points. And how much would you be up? 300. Right? Just some casual 300 points, right? And then if you're trading one contract, if you're down 20 points, that's only $400. If you're up 300, that is 6,000. You feel me? You feel me? Now that you know what a fair value gap is, we can start looking at inverse fair value gaps. For an inverse fair value gap to be created, we are looking for the same exact thing as a fair value gap. But instead of price reacting off of it and supporting price, we are looking for an invalidation of this fair value gap. Now, an invalidation is when we close outside of the fair value gap. So if we have a bullish fair value gap and we close underneath the bottom of this gap, that makes this entire fair value gap right here an inverse fair value gap. And for a bullish setting, if we close outside of the high of this fair value gap, that means this entire thing is now a inverse fair value gap. Now, inverse fair value gaps are great signatures in price to dictate if the market is going to reverse or continue in a certain direction, and also learning where the market wants to head towards. It is also a very good measure of determining order flow. Order flow in the marketplace is basically seeing where the market wants to head towards. If we want to go higher, we should respect bullish fair value gaps and disrespect these bearish ones. If we want to go lower, we should do the exact opposite. We should respect the bearish ones and disrespect the bullish ones. When this occurs with a key draw on liquidity that you're looking at, for example, previous day high, previous day low, high day, low day, session lows, highs, whatever, they tell you where the market wants to head towards. For example, you might think this right here is bullish. But let's say we are going lower and we are downtrending, and these three candles are just a retracement to the upside. If we inverse this fair value gap, that confirms that this right here was exactly that, a retracement instead of a reversal. If it were to be a reversal, we would hold this fair value gap to continue higher and hit some next level draws on liquidity. Now, let's also say there is a liquidity level right underneath us. If we inverse this fair value gap, where is the next point of interest and draw on liquidity that the market will likely head towards? Most likely towards this draw on liquidity right here. Because what are we doing? We are, one, respecting bearish PD arrays because there's a fair value gap here, there's a fair value gap here, there's a fair value gap here, blah, blah, blah. And we are disrespecting bullish. If we were to continue higher and leave this point of interest objective, then we should not have inversed that fair value gap and we should have gone higher, right? And literally it tells us that, hey, we want to go lower towards this draw on liquidity, and it gives you a very good indication where the market wants to head towards. And then the same exact thing for an upside trade. If we're like going higher, for example, and we move lower into a higher time frame fair value gap, then move higher and inverse this fair value gap, that kind of tells us where are we most likely to head towards. Probably that draw on liquidity to the upside right there. These inverse fair value gaps are also very good support and resistance levels, because if a fair value gap is created, there is an imbalance of buyers and sellers right here. And if we inverse that, for example, let's say there is a buyer right here, here, and here, right? And his average price is somewhere in this fair value gap. When the fair value gap gets inversed, he does not want to take a loss on his position. So when we trade back into that fair value gap, when he was in drawdown, psychologically, he's likely going to exit out of his position, which is going to act as resistance for us to continue lower. And then the same exact thing, if that dude is in a short and then we see the market rally higher, that dude's going to get emotional and say, yo, I don't really want to be in this position anymore because it's not playing out. When it goes back to break even to my entry, let me get out for a $0 profit, $0 loss, and instead rethink and reevaluate for another potential trade, and then that acts as support for us to continue higher. That's what happens when you look at the candles and look at the psychology behind them. So let's start looking for some inverse fair value gap. Let's look at the same exact example that we used for fair value gaps right here. Boom. But instead, we can see before there was a bullish fair value gap that was created. When we created that bullish fair value gap, price did not react off of it at all. Actually, a little bit. And then we inversed it completely. What did we do? We closed underneath it. Boom. What did we also do afterwards? We used that as resistance, right? We can see that we're holding this inverse fair value gap, and then we continue lower to that low of day objective that we were talking about. And then what happens for a reversal? We can see that we're going lower. We take out our low of day objective. Can you see something? Can you spot something? You should be able to see a fair value gap right here. And then the fact that we closed above it, that was an inverse fair value gap, and price, boom, moved higher off of it. An inverse fair value gap after a liquidity sweep is a very good indication of a potential reversal in the marketplace. The higher the time frame it is, the higher the probability of that reversal. So we can see that we're on a 15-minute chart and we inverse this fair value gap. Now, if I'm on like a 1-minute chart and we inverse that fair value gap, the probability of it hitting is lower, but it can still hit, right? Because we can see that, okay, we have a fair value gap right here. Let me get rid of that. We have a fair value gap right here. We're holding the fair value gap. And then until we inverse that fair value gap, a reversal does not occur. And you're waiting for that, right? We can see boom, boom, boom. Until we inverse that fair value gap, that's our first indication that, hey, a reversal is probably imminent in the marketplace. And what do we do afterwards? Boom. To the upside. So it is a very good indication of where the market wants to head towards, and also a very good indication of a possible reversal in the marketplace. So if you're looking for the middle of a range and a inverse fair value gap occurs in the middle of the range, let me draw it out. So let's say we're consolidating right here, and then let's say there's a fair value gap right here. If we inverse that fair value gap and we close right here, what's our next draw on liquidity? Probably this high right here. So boom. That's most likely to happen. And if there's a fair value gap, And if there's a fair value gap down here, and if we inverse it, what's our next draw on liquidity that we will likely hit? Probably this low and this low. And boom, it will use that as resistance to continue lower. That is the power of an inverse fair value gap. It is very, very simple. Because you know how to draw a regular fair value gap from the previous lesson, you should also know how to draw an inverse fair value gap. The only thing you are looking for is a closure outside of that fair value gap. So for a bullish fair value gap, let's see, boom, we have to close underneath it right here. Right as we close one tick below that fair value gap, that is considered an inverse fair value gap. And if we are looking for a bearish scenario, if we close one tick above that fair value gap, that becomes an inverse. And then we should use that as support to continue higher or lower depending on which direction the inverse is. Very, very simple. I don't think it is a very complicated concept to grasp because you already know what fair value gaps are. So don't even worry about it. But this is also very, very important and a very crucial concept to know for learning where the market wants to head towards and order flow. If you guys don't know what order flow is, it is where the market wants to head towards. Right? If we're bullish, we're going to respect bullish fair value gaps and disrespect bearish. If we're bearish, we're going to respect bearish fair value gaps and disrespect bullish. Simple as that. When we fail to do either and we're disrespecting both bullish and bearish, this is the biggest sauce you will ever find. That indicates that we are consolidating, chopping. There is no direction in the marketplace. So, unless you are a range trader, it is not viable to enter into the marketplace. And the best thing to do when we're just ranging and we're invalidating bullish and bearish fair value gaps is to just do this, right? We don't have to click buttons 24/7. You would think because as day traders, we have to be in a position all the time. But instead, the best day traders are the ones that wait 99% of the time, and then 1% of the time they execute and then let the trade play out. And that is how you should be operating day trading. Now let's start looking at order blocks. Also known as, I guess, supply and demand, order blocks. The thesis is this. We're moving lower right here. There are sellers moving the market lower. Boom, 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 right? When we go higher and invalidate those sellers will then become buyers for their positions to continue higher, right? So let's say there's a market structure shift. You should already know that. Let's say there's a market structure shift. When we retrace into a order block, that will be a previous seller trying to mitigate his position to continue higher, okay? So how to identify order blocks? They are the last either down close candle or series of down close candles before a move higher. So let's say we are going lower right here, and then let's say we move higher and we have that market structure shift. Our last series of down close candles would be somewhere over here in this leg to the downside, and that will be our order block for us to continue higher off of, right? And then in a bearish scenario, let's say we're going higher, boop, 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 and then we go lower. What is our order block? Last series of up close candles, right? And up close is basically bullish candles, because think of it psychologically. The market and buyers moved the market higher, right? And they were the result of the bullish candles. So when price retrades back into their average position, they would look to mitigate their position for a break even, which will act as resistance for us to continue lower. Okay, you should be screenshotting this. You should be taking notes on this. Now let's look to draw an order block on a chart. Where are order blocks? How can we find them? I'm going to use the same exact example because every single PD array is getting shown here. So what happens here? What are we looking for? An order block. What is an order block? The last series of up close candles before a move lower. So where is our series of up close candles? 1. There's no more. So what do? We mark this out. Let me make this a little bit thicker so you guys can see. And once we close underneath it, that becomes a viable order block. Before a move lower, boom, then we retrace back into that level and we use that as resistance. So we can draw this entire level right here. We use this as resistance to continue lower to our low of day objective. All right. And for order blocks, there are two main points that you should be really looking at: the entry point of it and then the 50% of it. In this scenario, we can see that price traded into that 50% mark and instantly didn't trade above it, indicating that we are likely to go lower. If you see this in real time and you see that, hey, we are not closing above this 50% level and it's actually used as resistance with a 1 inverse fair value gap, with a 2 regular fair value gap, with a 3 order block, that tells us that, hey, what is our most likely scenario to happen? Lower. So once we confirm that we want to go lower by sellers entering in off those levels, then that tells us that, hey, we likely want to continue lower to this low right here and low of day. Okay, now let's look for some more order blocks that have been created. This is a very good example right here. So we can see that price moves lower right here. Boom. We move higher aggressively. And then we pull back. What do we pull back to? If you are looking closely, you should be looking for a series of down close candles before the move higher. So it would be right here. Boom. Let's draw a rectangle on that as well. Boom. Mark that out. What happens? What do? We trade into it. What do we also react off of? 50% of it. And then we continue higher off of that. So the entry point and 50% of it is a very strong point of interest, and you should be looking for that. If we trade into that and we basically don't trade outside of it, like just barely wick it to that level, instantaneously reacting off of it, that tells you that, hey, we're likely going to hold this level and continue. So what you can do is look for a trade based off of that, right? You don't have to get in off the bottom right here because, to be honest, you don't know if it's going to hold. How will you base a trade off of it? Don't worry. Here, I got you. I got you. Now let's look at this move to the downside right here as well. We talked about it before. We moved higher, took out this high day liquidity, moved lower. We have what? Inverse fair value gap. Boom. Regular fair value gap. Boom. Did we trade into that regular fair value gap? No, we don't always need to trade into it. If we don't trade into it, that shows more strength in that direction. So the fact that we didn't trade into this bearish fair value gap and we held the inverse fair value gap, and also if you're looking closely, we closed underneath these series of up close candles. What happened right as we closed underneath it? Traded back into it, used that as resistance towards where? Low of day. Now these things are called PD arrays. An order block, iFVG, fair value gap, they're called PD arrays. And when we have multiple PD arrays nested, we don't need to trade extremely deeply in the very, very high one or the very, very low one, right? If we do trade into it, that still tells us that there could be resistance in this level. But the best scenario that we are very, very weak and sellers are aggressive is we don't even trade into this. And we hold the inverse fair value gap and also the order block for us to continue lower to low of day. That is how you draw order blocks right here. And let's draw some more. We can see our series of up close candles. When we close underneath those series of up close candles, they become an order block. In this scenario, what happens? We do not trade into this order block. That doesn't mean that the order block is not viable. That just says that, hey, we just haven't traded into it. And it shows more weakness to a particular direction. When we fail to trade into a certain PD array, that tells us that, hey, we are extremely weak to this direction and we will likely continue in that direction. And what happens right here? Let's zoom out. We hit low of day. I believe low of day is right here. Yep. Low of day is right here. Boom. 200 points lower. And if you're in one contract, that's $4,000. 200 points lower without even trading into this order block. Sometimes we don't need to trade into the order block, but the fact that we've created one is a signature in price to tell us where the market wants to head towards. And then we can also look for other signatures like, hey, fair value gap. We can see if we hold this fair value gap, then we will likely continue higher. If we don't, we'll likely continue lower. What do? Boom. Once we close underneath it, what happens? Resistance, resistance, resistance to low of day, right? It's very, very simple. Once you're able to spot these things in real time, it's so easy to determine where the market wants to head towards. Because if you have all these signatures in price, like, hey, we have that liquidity sweep, boom. We have an order block, boom. All right. We have a fair value gap getting fully invalidated. So an inverse fair value gap, boom. Right? There's no fair value gap in this scenario because there's just wicks. It's very, very wicky. But with those three, we still have more than enough confluence to tell us that we're likely going lower to low of day, right? It's weakness, hella weakness in the marketplace. I should be looking to establish short positions or just stepping away if I'm long biased. Let's draw a couple more. Let's look at this, for example. What do? We move higher, take out high day, boom, close underneath the series of up close candles, indicating that an order block has been created. We trade into that order block by one tick and instantly move lower off of it, indicating that the order block is holding because our two levels that we're looking for on the order block are the opening of it and the 50% of it. And then we move lower. What's our draw on liquidity? Low of day and previous day low. Where's previous day low? Right here. Can you guys see that? Yes, you can. And where's low of day? Right here. So low of day, boom, we go lower, hold below low of day, indicating that we want previous day low. What is also created, if you said relatively equal lows, good job. I like you. And we create relatively equal lows, consolidate, boom, move lower to previous day low. When you are looking at this, it is very, very easy to spot, hey, upside, downside, no trade, right? Like, for example, this, we could say that, hey, we want to go to towards high day. Once we take out high day, I don't want to look at the market anymore. And I will look for that same exact sequence in price. Once we take out a liquidity level, boom, we take out pre-market lows, instantly reverse off of that. What is created? Order block. Okay, fair value gap. Let me draw. Boom, fair value gap. And then we move higher towards high day. It's so simple. When you see this in real time and you see this trigger so many times every single day, that tells you that this might be something you should be paying attention to. But with that, you should know how to draw order blocks. Let's just go through it again. For a bullish order block to be created, we need to move lower right here. Boom, 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 boom. And then we close above the series of up close candles that was created in our last leg right here. So once we close above that, that is then used as an order block to continue higher. And if you pair that with a liquidity sweep, so let's say there's the liquidity sweep right here, and then an inverse fair value gap, and then a regular fair value gap with an order block, that is just a sexy ass setup telling you where the market wants to head towards. And then we look for the exact opposite thing for a bearish scenario. Our series of up close candles, boom. Once we close underneath that, then that becomes an order block. Price trades into that order block. It doesn't need to, but if it does, it should use that as resistance for us to continue lower. And if you pair that with a liquidity sweep with fair value gaps and inverse fair value gaps, then you can be on the right side of the market more times than not. So now that you know what an order block is, we can also learn what a change in the state of delivery is, which is a CiSD. So let me just write that down. You guys should be writing this down as well. Change in the state of delivery. Okay, aka a CiSD or CSD. A CiSD is very similar to a market structure shift. So let's say we're going lower right here. Every time we break a low and create a lower low, or if we're going higher and we create a high and a higher high, a break of structure occurs, right? But if we are in a downtrend, for example, and we make lower lows and lower highs, you guys should already know this, and then we go higher and break above this previous high, creating a higher high, that makes a market structure shift. So let's say we are going lower right here, and then we go higher over here. So very similar to this order block sequence over here. A market structure shift is when we close above the previous high that was created, this lower high, and create a higher high. So a market structure shift can only occur if we are creating lower lows and lower highs, right here, lower lows, lower highs, and then we create a higher high, indicating a market structure shift has occurred. And this market structure shift is fully confirmed if we retrace and create a higher high and a higher low. So this low is higher than this low, so this is a higher low, and this high, well, my bad, this high right here is higher than this high, and a higher high is created. This fully confirms a market structure shift. I don't think I said this in the highs and lows break of structures example, but that's what it truly is. So the change in state delivery is, let's say we're going lower right here. You're not waiting for the market to close above this lower high. Instead, you're looking for a candle closure above the series of down close candles. For example, when an order block is created, a change in the state of delivery occurs. So let's say this is our series of down close candles right here. When we close above it, instead of this internal high, let me just get rid of this entire drawing. So like, let's say we're going lower right here. If we have our series of down close candles over here, we have the lower high right here. If we close above this swing high, then a market structure shift occurs. If we close above the series of down close candles, then a change in the state of delivery occurs. This is a different confirmation of a market structure shift, because let's say our series of down close candles is right here. When we close above the series of down close candles, aka the sellers that drove price lower, that tells us that these sellers are now underwater on their position, so they will look to mitigate their position for a net neutral gain, okay, for it to continue higher. And then for a bearish scenario, let's say we're going higher, la-di-da-di-da. what happens? What are we looking for? Our series of up close candles, not down close this time. So let's say our series of up close candles are right here. Once we close below this, we don't need to close underneath this swing low right here. Once we close underneath the series of up close candles, that confirms the change in the state of delivery. Once we close under this swing low, then a market structure shift is confirmed. Okay, so we can trade into that and go lower off of that. And it's basically you're getting the same confirmation of a move. So let's say this market structure shift, but you have a better entry, right? So you have an entry over here, and let's say like it goes lower and it never trades into this market structure shift or whatever. You have a sexy ass entry all the way up here. You sold up here. Instead of entering into a position, let's say over here or here or here or all the way down here, you're entering very, very near the top. And when you combine it with, let's say, a liquidity sweep up here, boom, liquidity sweep, a fair value gap. So let's say this right here is a fair value gap with a liquidity sweep. And then let's say this over here is a inverse fair value gap. And then this over here is a regular fair value gap. And then a change in state delivery occurs, all before a market structure shift. If that occurs, you don't have to lean towards this market structure shift and then miss out on this huge move to the downside. Instead, you can look for this confirmation of a change in the state of delivery, see that these buyers that drove price higher are all underwater, and once we trade back into that level should be used as resistance for us to continue lower if our bias is to the downside and if our bias is correct. If it isn't correct, then we will just continue higher and trend higher, because let's say liquidity is all the way up here. You're not going to take a change in state delivery over here or a change in state delivery over here or here or here, because you know that the objective and that drawn liquidity is the first thing you should be looking for. So if we don't have that and our drawn liquidity is to the upside and not in the favor of our change in state delivery, of our fair value gap, inverse fair value gap, what else? Market structure shift, then this entire thing doesn't matter, because there's no direction, there's no framework behind your entire trade. You're just basing it off a candle pattern, when that's not how the market moves. It mainly moves off of liquidity and where liquidity is lying. So if you look to position yourself where the liquidity is and trade towards that, you'll be on the right side of the market more times than not. So you can look for that instead of just trying to look for a candle pattern, looking like, hey, change state delivery, let me look to short. And then we have a liquidity level over here. Can it work out sometimes? Sure, right? Like this scenario, it can work out. But let's say we have it over here and we have that change state delivery. It can fail more times than not. So it's really not worth it. You would want to pair it with our liquidity levels, change state delivery, fair value gaps. You'd want to pair it all together and then form a thesis off of that, right? And this is why I'm teaching you this change state delivery. This is why I'm teaching you inverse fair value gaps, order blocks, regular fair value gaps, liquidity. I'm teaching you all these things just so you know what to look for, okay? When this occurs, then this occurs. Then I'll look for this. Then I'll look for XYZ, right? And if ABC is not there, then I won't look for XYZ. And if I just look for XYZ, then I'm just looking for patterns in the market, and that's not how it moves. So now that you know what a change in state delivery is, let's start marking out some CiSDs in real time, okay? We can see that the market is moving over here, and we can look to, let me go on the hourly and just mark out some change in state deliveries. So we can see that we go lower, order block created, change in state delivery occurred, right? Because you know order blocks and you watched that order block session, and hopefully you watched it and you took notes, you should know how to draw a change in state delivery as well, right? So boom, right as we close underneath this series of up close candles, a change in state delivery occurs, okay? For a upside change in state delivery, right as we close above these series of down close candles, a change in state delivery to the upside occurs, okay? For a market structure shift, right as we close above this swing high, a market structure shift occurs, and right as we close underneath this swing low, a market structure shift occurs, okay? Let's mark out some more change in state deliveries. So boom, change state delivery occurred, we move higher off of it. Coupled with a liquidity sweep, what happens? We take out low of day right here, boom. Hourly change state delivery occurs, boom. Trade into the order block, and we move higher off of it, okay? And then we trade into this external draw on liquidity, okay? This should be making sense to you, okay? If this isn't making sense to you, go back in the video and start reviewing more things, because you see liquidity, changing the state delivery, coupled together, PD arrays coupled together when that occurs with an external draw on liquidity, which is a upside trend, downside trend, boom, look to target that, right? Another one, let's look for another one. A change in state delivery occurs over here, right? Now you might be like, why am I not marking this series of down close candles right here? Why am I marking these ones over here? We can see that the last series of down close candles that was created on the leg to the downside. So what is our change in state delivery? So we're going lower right here. We can see that over here, let's just mark it. So this is our change in the state delivery, I guess, context. Okay. How would we couple it over here? Over here, we go lower, but we don't take out this low over here. Boom. We can see that if we zoom in, let's zoom in. If we zoom in, you can see that this low over here is not lower than this low. So we take the lowest low and take our last series of down close candles in that lowest low. And what happens? We mark it out, get rid of this one over here. We mark it out, price trades into it, respects it, continues higher. And when do we do it? After taking out this draw on liquidity to the tick. You can literally see, like, this is like so precise. We take out this draw on liquidity to the tick, boom. Okay, what happens? Boom. And then change in the state delivery occurs. What happens again? Barely any drawdown. Let's say you enter into a position off of this change in the state delivery and the order block. Boom. Like, you can see that we barely even dig deep into it. Like, we just tap it and moonshot higher off of that. So what is the drawdown in it? 12 points? Freaking what? $200? Nothing per contract, okay? And what is your reward? Let's say you enter into a position and you're targeting this external high. 500, which is 10,000. So $200 of drawdown for a $10,000 reward, right? And this is how precise it is. And coupled with, what is it? Fair value gap. Boom, right? With the 50% of the fair value gap, which also lines up with the change in the state delivery order block, okay? And then we move higher, and then it's so simple. It's very simple. So that is how you draw a change in the state of delivery. For our next lesson, let's start talking about breaker blocks, okay? Let me just write it. Breaker blocks, aka BBs. So that's how I'll write breaker blocks in this. A breaker block is created when a market structure shift has occurred and we close above. So like, let's say we're going lower. If we close above this leg over here is considered a breaker block, okay? So it'd be that leg in price. So boom, boom, boom. So this right here, if we extend it, this is our breaker block, okay? So for a upside trade, we go higher right here. So like, let's say right here, it would be our entire leg. If we close underneath this, we look for our market structure shift. Boom, market structure shift has occurred. And then you look for that entire leg in price. So boom, boom, boom. So my bad. I cannot draw. Boom, 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 boom. So this entire thing right here is a breaker block for a downside trade, right? And you might think, yo, these are very similar, right? Like if we go into order blocks, this move to the upside occurred with a breaker block, right? With a breaker block, right? And then what else? Is there another one? No, I didn't draw it. When a breaker block is nested within a fair value gap, so like let's say a fair value gap right here, and then there's a breaker block over here. That is what is called a unicorn, okay? And when it is also nested with a order block, okay, change in the state delivery, inverse fair value gap, everything is lining up. And then you also pair that with a draw on liquidity. That gives you framework on a trade. And let's say there is this low right here, and then we go lower and relatively equal lows, okay? Let me draw that. So this is our sequence in price. We go lower, create relatively equal lows with another drawn liquidity. So like, let's say something over here, right? my bad, my drawing is kind of bad. And we go higher, take out this drawn liquidity. What happens afterwards? Zooming in, breaker block is created, fair value gap is created, chain in the state delivery occurs, inverse fair value gap occurs, market structure shift also occurs because a market structure shift occurs after or before a breaker block is created. So we need that market structure shift for a breaker block. And then we retrace back into it. All these points of interest coupled into a singular price point kind of gives you a higher confluence and more confidence on this to go to the downside and for us to move lower. And then there's fair value gaps here, right here, and then also probably like this right here is probably a fair value gap. So one, we trade back into it, we're trading into an inverse fair value gap and also a regular fair value gap, and we continue lower to our drawn liquidity, which is down here, right here. Okay, very, very simple. Let's draw some breaker blocks in real time. Okay, so how do we draw it? We look for a market structure shift to occur, and then we look for our last leg in price. Okay, and we draw that entire leg as the breaker block. Okay, so what do we look for? A move higher, then move lower, and then we look for a market structure shift. So let's look for a breaker block. Boom, let's look at this. So we move higher. What are we looking for? Boom, 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 and then a shift in structure for us to continue lower, right? Let me just put that there so you can, I guess, refer to it. How do we look at that? And let's look at this in real time. Let's couple it with a drawn liquidity. So what do we do right here? We take out this entire range high and also this range high, right? We move higher. Then we're looking for this signature in price and our market structure shift. Market structure shift occurs under this low. Once we close underneath that low, then boom, a shift in structure has occurred. Boom. Once we close underneath that low, this entire box becomes a breaker. Okay, let me make this red for you guys, indicating that it is a bearish breaker, and it confirms, right? And you would expect it to hold if we want to continue lower, right? So we can see that we close underneath the breaker block right here, and we have that market structure shift. We trade back into it, and we use this as resistance afterwards because these buyers right here that move price and also this entire leg in price is now being used as resistance for us to continue lower. And if we have a drawn liquidity to the downside, so like let's say this low right here, we should trade into that with ease. Okay, and we do exactly that. We can trade into that, move lower, retrace, move lower over here, right? And then this move lower is to trade into some next drawn liquidity over here. But our main drawn liquidity is all the way down here on this low over here. Okay, or even the weekly low. I think we even trade down into the weekly low on that same day. No, the day after. But still, right? This entire move, we trade into that weekly low afterwards, I think. Yeah, to the tick. Boom. And right as we take that out, we have that strong bounce, which can also base a trade idea off of, right? So that is a breaker block. Let's draw a bullish one. What are we looking for? A market structure shift to occur. Okay, so we look for, we go lower and then move higher this. Okay, so because we're looking for that, we need that structure shift above this high. And then like a market structure shift can occur, like let's say right here, boom, 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 right? You might think, okay, since we're retracing higher, a market structure shift is occurring, boom, because we're creating higher highs and higher lows, but we need to trade above this high right here. Okay, and then vice versa for a short, like we need to trade below this low right here. So once we trade into that, my bad, let me keep that on. Once we trade into that and hold above it, close above it, then a breaker block is fully confirmed. Okay, so let's say, okay, we're going lower, boom, we take out this low, a breaker block would be over here. So it would be this entire price leg. Okay, and then we go lower and create a new price leg. Where is this high? My bad. Where is this high over here? It would be over here. Okay, so now we can draw another breaker block. Boom, right here. And once we close above it, then that fully confirms that breaker to hold. We can see that, okay, we have closed above it, retrace into it, use that as support for us to continue higher, and we do exactly that, right? Boom, boom, bada ba boom pow. Okay, and then you look to target your external draw on liquidity, either this high, or you can just look to target this weekly high or high day or whatever, daily high. Okay, you don't need to target this entire range high. You can just like look for a small piece of the pie and then just look to compound that over and over again, right? A base hit is a-okay. You don't need to capture the entire move. You might think day trading is like, hey, let's capture this entire move. I need to have the best entry and then the best exit for me to make the most money, but that's not the case. Okay, with day trading, you can make more money capturing a smaller piece of the move, because if that smaller piece of the move is more probable and you have more confidence and you are sized heavier on that, you'll make more money. So like, let's say for example, you're in only one contract for this entire move higher and we have 800 points, which is $16,000. Okay, how would you make more than $16,000 on this 300 point move? You size 3 times heavier, right? So that would be 900 points, right? Let's say you're in 3 contracts and then you make more money than the person who captured the entire move, right? You capturing a smaller piece of the move with more size gives you less time in the market, less time for your emotions to be like, oh my God, this price is retracing, I should get out, right? Like imagine you're in a trade and then we go lower and then boom, like we go higher. But this move to the downside, you're shaking. You're like, holy crap, I don't want to miss out and lose out on this money, because this move to the upside is 300 points, 350, which is what, $6,000, $7,000? You can make it, sure, this trade hits 16,000. But when you're up 6,000, you're like, holy crap, I'm up 6,000. Like I don't want to lose out on it. You know? Do you have the balls to hold for 16,000? That's the biggest thing. Or would you just like to capture a smaller piece of the pie with more size, and then you make more than 16,000? Let's say you make 20, 25,000, and you're able to do that more consistently because you're just capturing a small piece of the pie, and then right as you take that, boom, you're out of the market. You don't need to like hold on to it. I don't know why I gave that psychology lesson at this point of the video, but still, this is how you draw the breaker block, right? We closed above it, traded into this high, and we moved all the way higher to that external high over here. But yeah, that is how you draw breaker blocks. A breaker block is almost always created before a reversal, so we don't always need to trade into it. That's the biggest thing. If we do trade into it and we hold it, that gives you confidence that we will continue in the direction of the breaker block. Like, let's say this one is bullish. Let me make it green. Sorry, guys. Let's say this breaker block is created and you have an upside bias. The fact that we're holding it gives you confidence that we want to continue higher, right? And if we don't hold it, that tells you that, hey, my analysis can be wrong and we can likely continue to a lower draw on liquidity, maybe this low right here. But if we hold on to it, a reversal can occur. Are you writing this down? You should be. And that is breaker blocks for you. So now we can start looking at premium and discount, aka equilibrium. It is basically a range in price. Okay, so let's say we are moving lower over here. Okay, we would look for equilibrium of this range if we want a retracement to continue lower. Okay, so how do we draw equilibrium? Let me see. I think it would be shapes and lines. Yeah, okay. So we can draw this right here and then draw 50% of this range. Okay, this box right here is going to be our premium and discount range. With this, we want price to trade above like this 50% point, aka premium, which is a premium of this range. The bottom is a discount of this range. We want price to trade into a premium and trade into a higher time frame fair value gap, take out some internal draw on liquidity inside premium, aka this high, which is also probably some fair value gap over here, and then continue lower to our objective. So this is the main basis of premium and discount and where I look for a continuation. Okay, I'm not looking for a continuation like can it occur over here? Yeah, but the best point of interest where my idea and my risk to reward is most valid and highest probable is above 50% of this range, because we also have to think about it algorithmically. Let's say we're going higher over here and we are in a deep premium of this range, right? Let me get rid of this bottom draw on liquidity. Let's say there's a draw on liquidity up here. We need price to trade back into 50% of this range, and algorithmically we have higher frequency algorithms that look to buy once we trade into 50%. They look to buy once we trade into certain levels, aka golden pocket of this range, standard deviations, fib retracements, okay? When price trades into these levels, these high frequency algorithms are looking to buy because the market is going higher and we have that drawn liquidity higher and it is pushing to a certain direction, okay? When we do have that, we retrace into 50% of this range, and you want to be positioned on side with the large money, which is what they're doing. They make the market pull back because when you see this, for example, when you see this, you are probably like, we're going higher, let's look to enter into a long position, okay? That's what the market wants you to think. That's how the smart money wants you to think, right? What they do is when people enter into long positions all the way up here, not realizing that we need to retrace first before going higher into this drawn liquidity, money is established, okay? Let's say money is established right here, 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 here. For them to take all that money, we have to retrace, take out some internal sell side, and then continue higher to our drawn liquidity, okay? So this right here is likely a fair value gap. Boom, okay? And we move higher after trading into this fair value gap, after taking out this drawn liquidity, and after trading into 50% of this range, okay? And this is the exact same thing on a downside scenario. So like, let's say, boom, right here, move higher, trade into that 50% and also a higher time frame fair value gap, then react off of that fair value gap to continue lower to our downside objective. Right? This is very, very simple stuff. So premium and discount is the premium of a range, discount of a range. Ideally, you want to be buying in a discount, selling inside of a premium, because that is where you have the highest probable chance to win on a short position in premium and a long position in discount. Okay, so let's draw some premium and discount ranges over here. Let me get rid of this and let's draw. I think we had a perfect premium and discount today. The market's moving right now, okay? So this is the best time to show you. We had a retracement and then continuation higher, okay? So let's go on to the 15-minute. Let me get rid of this as well. What did we do? Let's mark our draws on liquidity first. We have low of day marked down here, okay? And then the high of this range. Let me go into replay first. So this is what the market is looking like at market open. Let's mark the entire daily range and do a premium and discount of that. I think let's do that. Yeah. Of this range. So premium and discount of this range. If you're like, yo, I want to have these Fibonacci settings, it would be a fib retracement. Copy these settings right here. Okay. Screenshot this, copy it, and this is what you'd be looking for. All right. Now that you have this, click OK. What happens? Ideally, we're looking for a retracement into 50% of this range, the daily range, and then continuation higher, okay? Is there a fair value gap inside 50% of this range? Yeah, we have, whoops, my bad. We have this fair value gap over here, down here, right? Like we see a small portion of it is inside 50% of that range. Okay, lit. What about the 15-minute? Is there a 15-minute fair value gap? Okay, we have one down here, but don't know if we want to trade into it, but we can, but it is what it is, right? What happens? Let's play it. Boom. Price trades into it. We can see that price reacts off of these levels perfectly. And what does it do? Continue higher, right? This is the power of premium and discount. This retracement right here, people might be thinking, hey, we're going to sell because we're at all-time highs, or this is a downtrend starting. Not realizing that instead of a downtrend starting on a lower time frame, right? Like on the 1 minute, you might be super zoomed in, and this is how the market gets you, right? Let's get rid of this. If you just look at this, on the 1 minute chart with everything I taught you, you're looking at this. What do you think the market is going to do? Likely go lower. This is why we need to have context in the marketplace. So let's draw our premium and discount range again. So from the high of the day to low of the day, boom, right there. Let's draw it out. Boom, boom. And then let's draw our fair value gap as well. So we have that fair value gap over here. 1 minute. Now, you see this in price. You see price trading into 50% of this range. You see price trading into that fair value gap over here. Boom. With this context, what do you think the market is going to do next? Huh? Mainly, like if you should be like, hey, we're going to go higher. Okay? Because we're reacting off of 50%. Boom. We're reacting off of this fair value gap. Can you guys see this? Boom. Okay? And you wouldn't be looking to establish a short position down here. Why? Because we are in a discount. You don't want to be shorting in a discount, and you don't want to be longing in a premium unless we're reacting off of that and we are continuing higher off of that. Okay, so unless we are going lower and then retrace and then go lower, it's okay to, let's say, this is a premium and discount range. Boom. Since we tapped into premium and we're reacting off of premium, shorting in a discount after we traded into premium, after we traded into the fair value gap right here, boom, then it's okay. But shorting in a premium down here or discount down here, you don't really want to be doing that. Ideally, you want to be shorting in a discount after we're reacting off of premium of this range. Okay, so like in this scenario, boom, let's do that same exact thing. Reacting off a discount. Now I can look to establish a long position. Okay, so what happens? What is created? Fair value gap. And let's see how this plays out. Boom. Okay, our drawn liquidity is high of day. Once high of day is hit, boom, we've captured our piece of the pie. We don't need to capture 1,000,000%. The entire move, the high of day to low of day to high of day, we don't care about that. We just care about capturing our portion of the move with significant size. Okay? You don't need to capture, let's say, 100 points with small size. Instead, you can capture 10 points with 10 times that size that you're using with that 100-point trade. Right? And the probability of you hitting that 100-point trade is kind of low. You might take like 4 or 5 losers in a row before you capture that 100-point trade. Instead, you can capture a portion of the move with significantly more size and make so much more money. Okay, boom, we move higher, trade into discount of this range. So let's draw some more premium and discount ranges. So going on the daily, boom, right here. Let's go on the hourly as well. We can see that we're going higher, higher, consolidation, lower, right? So what are we looking for over here? We look to establish a premium and discount range of the entire range, so the low to the high, boom. Let me draw like this, right? Ideally, you want to be shorting in a premium, longing in a discount once a range is established. Once we're down here, you're not really looking for shorts too much. We take out internal sell side, boom, this low is taking out. What happens? Move higher, fair value gap created, move higher off of that, okay? Then we take out sell side again, take out this internal low, boom, and then move higher off of that. Fair value gap created, trade into that fair value gap, continuation higher. What also happens? Inverse fair value gap. What also happens? Change in the state of delivery. What happens when we have that change in the state of delivery? Right here, price trades into it. Boom, continuation higher. Okay, very, very simple stuff. Once you start seeing these in real time, it's so simple to predict where the market will head towards. And if it doesn't head towards that, it shows an invalidation of your thesis, and the opposite can happen. Okay, the best thing about day trading is when you're wrong on a move, what is the other thing that can happen? Let's say you are expecting upside prices and your invalidation level of that upside thesis is hit. What is the next possible scenario to happen? Likely downside, okay? Downside or sideways. It's probably not going to continue to the upside if your analysis and your invalidation level is correct. So with that, you can look to switch your bias and look for a downside trade. For example, right here, boom. We have this move higher. Like we took out this sell side over here. Can you guys see that? No, you can't. We took out this sell side, boom, right? And then moved higher, fair value gap, inverse fair value gap as well, and then moved higher. And then your invalidation level, let's say you're established in this position, your invalidation level is once we have a market structure shift to the downside, or once we take out this low, right? Once we have that and we fail to continue higher over here inside premium of this range, that tells you, hey, we will likely continue lower. What's our next draw on liquidity? Probably this low. Then I'll look for a possible continuation to this low down here, or a reversal all the way up to this high and this high. What happens once we take out that low? We fail to displace lower, which is basically close below this internal low, and we reverse. What should you do with that? You should look to switch your bias. Okay, we're likely not going to continue lower. We're starting to move higher. Let me look to position myself according to the marketplace. Instead of what I want, let me look at what the market is telling me and then position myself to that, right? And we go higher, retrace, change state delivery, fair value gap, inverse fair value gap. You can see that we're holding these levels as well. That tells you the biggest thing, like, hey, we're holding these levels. Bearish PD arrays are getting disrespected. Bullish PD arrays are getting respected and created. What's our next objective draw on liquidity? Probably this internal high and this internal high, right? Once we take out this high, we have a retracement to continue higher again. Okay, very, very simple stuff. And then once you pair all that together with your PD arrays and what you learned before, it's just so simple to see where the market is heading towards. Let's do another one. Oh, this is a good one. This is a very good one. We can see that we have a large move to the upside. Okay, we have a consolidation range, liquidity sweep. We take out this internal low and then large move to the upside. We don't have that move until when? Boom. In this entire range, you can see that we're chopping. We're not doing anything. We're going sideways, not amazing price action. Until we trade into 50% of this range, aka discount of this range, take out internal sell side, and also trade into a higher time frame fair value gap, then and only then can we continue higher. Until we do that, we will likely continue going sideways, and it won't be amazing price action. You need to understand this. If we fail to trade into 50% of a range, we will fail to have amazing price action. Simple as that. Because the market can continue going higher, sure. But if everyone knows that the market is going higher, it will automatically not give amazing opportunities and do so in a way that kind of manipulates a lot of people. Okay? When it is going higher, let's say it's going higher, and it just doesn't have that 50% pullback, it's going to do some chop nonsense and then go higher instantly and then do some whatever nonsense and then do that exact same thing. If we don't retrace into 50% of this range, we can't have a good move to the upside or downside. So until this 50% is hit, then and only then can you establish a position. Then and only then can the market truly move higher to where it wants to go. You can see that, hey, we're chopping all the way until 50%, and then the move to the upside truly occurs, right? It's very, very simple. Even this move right here, even this consolidation move right here, we can see that consolidation. I'm on a 4-hour candle, okay? So this entire range is how many days? 2 weeks. Imagine 2 weeks of sideways consolidation. what happens? You can see that until we take out this sell side liquidity, we don't move higher. And also, what does that line up with? Let's draw a premium and discount range. Boom, boom, bada ba boom pow. Okay, we need to take out internal sell side and draw on liquidity inside discount of this range, and then we actually continue to move higher. We're grinding higher, grinding higher. Boom, huge dump. What does it dump into? Let's draw. Let's draw. Now, is this a coincidence? I think not, right? It's so simple. You can see even here, we move higher, consolidation, take out internal sell side, and then move higher. Let's draw our premium and discount. What happens? Boom, boom, boom. You can see that this is literally perfect. Like, we don't trade into discount of this range. We don't trade into discount of this range. The second we tap into it, literally, like, let me zoom in for you guys. Once we trade into 50% of this range, then and only then do we actually move higher. Okay, it's like it's happening every single time, and it's so easy to predict. And this is how the market just takes all the money. Like, this move to the upside right here, easy to trade. Okay, a lot of people are making money. This sideways consolidation, everyone is losing money until we hit 50% of this range and we start moving higher. Then everyone's making money again. And then what happens? Everyone's losing money. And then everyone's making money. And then everyone's losing money when it goes sideways. People think that, hey, just because we have one good trade, I'm a profitable trader. No, hell no. Instead, you should know when to put a position on and when not to put a position on. Once you learn to do that, then and only then can you actually take a step forward towards becoming a profitable day trader. Okay, let's draw some more. I think you guys know the premise of this, but still, let's draw some more. This entire range, boom, boom. Okay, let's draw it. Until we hit 50% of this range, we don't move lower. Consolidation, retrace, 50% into what? Fair value gap, boom, move lower. Okay, what else? Consolidation, retrace, 50%, go lower. Retrace, 50%, fair value gap, move lower. Okay, and then move lower. Yep, consolidation, expansion, retrace into 50%, move higher. Okay, how would you capture this move right here? Look for the low and the high that was created during that entire move. So low, high. Let's draw our fib. My bad. Boom, boom. Boom. 50%. When do we trade into 50%? Do we trade into it right here? No, we don't. Okay, because the range would be over here. So a 50% retrace would need to go all the way down here. And then we create a new range, take out this high, and create a new high, creating a new range. Do we trade into 50% over here? No, we don't. So what does that mean? This retrace to the upside, fake, manipulated, for us to continue lower towards where? This sell side liquidity to go lower. And then once we take out the sell side, then and only then can we actually move higher. What do? Move higher. Simple as that. Okay, very, very simple. Okay, like let's look at this right here. Go on the hourly chart, boom. What is our entire range? Like we see this huge move to the upside. Let's draw a premium and discount of that entire range. Boom, boom, boom. Right? Once we trade into 50%, then and only then do we actually move higher. Boom. Right? It's very, very simple. Did you guys see that? Yeah, I think you guys did. Right? It's very, very simple. And once you see this, and once you're able to identify this, you will know if a move is fake or real, depending on if we are in discount of a range, like this for example. Until we hit discount of a range, the move is fake. Okay? This move to the upside, you know that's not going to continue to the upside because we didn't hit discount of this range. And also we didn't take out any sell side liquidity. Until then, and only then, can we move higher. That is a signature in price. We cannot move higher until we trade into 50% of this range. And if we do, like this for example, that tells you that it's a fake out move for us to, I guess, manipulate buyers into thinking, hey, we're going to continue higher. Oh my God. Like imagine, let's look at this. You look at this. with everything you know, you're probably like, oh my God, this is sexy as hell. Fair value gap. Okay, lit, right? And you're probably looking to long this to continue higher, and you're going to get cooked because you don't understand the concept of premium and discount, okay? Like, you know that, hey, you think we're going higher just because we have a fair value gap, but it doesn't matter if we just have a fair value gap. If it doesn't line up with our thesis, if it doesn't line up with our framework, and we haven't traded into discount of a range before going higher or premium of a range before going lower, then that tells you that it's likely just a fake out move to get you into a trade. So the smart money and the people that are actually moving the market can take your money and then move it in the direction where it should actually go, right? Imagine everyone that's looking at this, looking to take a long position off of this, and they get cooked. Why is that? Because it can't move higher until we take out a sell side liquidity, and it can't move lower until we take out a buy side liquidity. And for every buyer, there needs to be a seller. So what the market makers, what they do is they manipulate you into thinking you're a buyer over here. And they want you to think, hey, we're going to continue higher. This is amazing to the upside, without you knowing that we haven't traded into discount of this range before going higher. This is how they do it. This is how they trick you. So like, let's look at this one right here. So this entire move to the downside right here, okay? It is a daily one, a daily retracement to continue lower. So we draw from the top of the move to the bottom of the move, right? Boom, boom. And we need 50% of that range to get hit if we want to continue lower. So we draw, boom, top to bottom. Until we hit 50% of this range, we cannot move lower. What do? Move higher, trade into premium of this range, consolidate, move lower, and react off of premium. Once we establish that we're reacting off of premium, that gives you enough framework to tell you that we are going lower, okay? Very, very simple. And this retracement can also just be a retracement into discount of a previous range, okay? So with this, you're looking for discount of another range to get hit. And then once discount of that range is hit, this external range, we don't move higher until then, right? Very, very simple. So it's ranges within ranges. So you might look at this move to the downside. You're still looking for downside because we haven't hit 50% of this range. Boom. So what you would do is draw 50% of this high to this low, this move. Boom. Hit 50% of this range. Go lower, hitting 50% of this larger range, this larger trend, right? Because we know that this is just a micro trend to the downside. The larger trend is to the upside. And for us to continue higher, we need a retracement into 50% and then continuation higher. What do? Trade into 50% right here and then move higher. Instant reaction. You can literally see how strong we react off of it. Let me get rid of this drawing right here. You can see how strong we react off of it, right? And I didn't even know we were going to react off of 50% of this range because this is back in like 2023. And this is not even me being in hindsight, okay? Like when I was drawing this in real time, I forgot how the market was moving. I didn't even know if it was going to react off of 50% of this range. So it's giving me confidence doing this right now. And also it should also be giving you confidence that it's actually holding and it's showing time and again that it's working, and you should be paying attention to it. Last one, I'm being dead ass. This is actually the last one. This move right here. Whoops, my bad. This move right here. What is this? You know what? Let's go on the monthly. This move right here. What is this? Retracement. And this is on the monthly chart. What do? Mark out the high and the low of the range. High, low, boom, 50%. Where's 50%? Right there. Where's the fair value gap underneath 50% of that range? Right here. We can see that price trades into that fair value gap. Continuation. Okay. Weekly. Boom. And we can see that we go lower, but we still have that fair value gap to get traded into. What do? This move right here is just what? A retracement. What do? Draw top of the range to bottom of the range. What do? Hit 50%. What do we also do? Fair value gap inside of premium. Go lower towards what? A higher time frame, 50%. Literally the same exact thing. It just keeps happening over and over and over. And you can do this on a daily chart, on a monthly chart, on a 15-minute, 1-minute chart, right? This happens on every single time frame all the time. Okay, so I literally showed you it happening today in real time with the market moving. And this is what happened back in 2022, 2023. And I showed all of this to you so you can ingrain we cannot move higher if we don't trade into discount of a range, and we cannot move lower if we don't trade into premium of a range. Let me draw this one more time. If we are moving higher, boom, 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 we need to trade into discount of this range first before continuing higher. Or if we are moving lower, we need to trade into premium of this range before continuing lower. If we continue and keep trading at these levels, should you be looking to establish positions? Probably not. Your highest probability trades will not occur down here until we retrace and then go lower. You've seen this. You've literally seen this. So I can't be like, this is just some fairy tale concept and you just got to trust me with this. You saw this in real time. Like, you see this. 50%. Once we trade into the fair value gap inside a discount, then we move higher. Once we trade into fair value gap inside of premium in this daily, then we move lower. Well, how many more did I draw? I drew this move lower, this move. I drew so many ranges to the point where it's so easy for you to determine it. Like, I can also probably call this entire leg to the downside. Let's do it, okay? Monthly chart. Let's draw the top and bottom of the range. Boom, top to bottom. What do? Trade into 50%. What is inside 50%? Fair value gap. And that entire tariff move that everyone was so focused on. Everyone thought that the market was crashing, that the president didn't know what to do with the economy and he was going to ruin the entire world. What was that? That was just a retracement into 50% of this range, into a fair value gap to continue higher. And this is not just me saying this in hindsight. I was saying this when it was happening in real time. You can literally go into my Discord server, go into charting sessions. I'm being so dead ass. Like, go into charting sessions over here. Boom. When did it happen? April 2025, 7th. Okay, boom. Go all the way to April. April 13th, 7th, it's this one right, yeah, April 6th right here. Let's literally play this. Look at my bald-headed ass. I'm looking at this fair value gap, this monthly fair value gap, and then looking for a continuation higher off of that. And let's see how it played out. That same fair value gap, let's go on the same monthly chart, okay? Boom. I'm marking this monthly fair value gap, and we go higher off of that. Marking that same monthly fair value gap, and we go higher off that. This is not hindsight. I did this in real time. I caught this entire move to the upside. So you should be listening to me more. I'm not saying this in hindsight like other people do. I say it in real time, and this happens in real time. It's easy to identify this in real time, and I want to give you guys the skill set to do so as well. And once you see it happen over and over again, bro, it's dead ass so easy. I'm being so dead ass. It's just so easy. But that is how you draw premium and discount ranges and look for trade opportunities. Once price trades into a premium, like a sell opportunity once price trades into a premium, and a buy opportunity once price trades into a discount, okay? So now for the next super duper pooper scooper important part of the video, we are going to be talking about SMT divergences. I did a recording before this, but it turned out to be dookie water, so let's do it again, all right? What is an SMT divergence? And let's break it down. An SMT divergence is when two correlated assets, emphasis on correlated, they have to be moving in sync with one another, stop moving in sync. When one makes a higher high, for example, so like boom, 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 boom. Let's say this is asset number one, and then asset number two makes a lower high. This is a very key sign that large money behind the scenes is loading up a short position on the second asset and can indicate a possible reversal to the downside. It is basically when one asset makes a higher high, the other asset makes a lower high, indicating weakness. For a downside scenario, let's do 1, 2. For a downside scenario, we are going lower. We make a lower low on asset number one, and then asset number two, we make a higher low, indicating a possible reversal. And if we are trading into a key level, for example, a drawn liquidity is taken, right? And we have this SMT, there's a very, very high chance for a possible reversal, and longing the stronger asset is what you want to be doing on an SMT divergence, and then shorting the weaker asset is what you want to be doing when a SMT occurs. So for your correlated assets, you want to be looking at ES and NQ. If you're trading Euro USD, you want to be trading and looking at Euro USD and DXY, for example. Whoops. And DXY. If you're trading GBP USD, you want to be looking at DXY because they're both USD pairs. Okay. If you are trading YM, so the US 30, which is the Dow Jones, you want to be looking at ES. So YM and ES. If you're trading gold, for example, XAU USD, you want to be looking at XAG USD, which is silver, or DXY because it is a USD thing. If you're trading Bitcoin USD, then you can be looking at the total market cap of the entire crypto market, or Ethereum, or Total 1. I believe Total 1/2. I think one of them is just showing the market cap of Bitcoin and Ethereum, and then the other one is the total market cap. So if Bitcoin makes a lower high and the entire market cap of the entire crypto market makes a higher high, kind of tells you that there's weakness in Bitcoin and there's more money flowing into other assets aside from Bitcoin, like Ethereum, the other ones, I don't know, I forgot. But it gives you a very good sign to determine weakness or strength with a current asset when you look at the correlated asset. And a key thing is 95% of all reversals have an SMT. Okay, so it would be like 95 to 97%, okay, of all reversals have an SMT. If you see an SMT and a reversal sequence is occurring, it will give you a very high chance that a reversal can occur if we have an SMT paired with it. So let's draw some SMTs in real time. One very good one. One very, very good one. So we can look at ES and NQ. We're looking at ES on the left, NQ on the right. We can see that NQ took out previous day high right here. So I've marked it out already. Took it out at when? 9:45. Yeah, 9:45 a.m. At 9:45 a.m., we can see ES made a lower high, indicating a possible reversal, and we can possibly go lower. If you looked at this in real time and saw, hey, we have strong weakness with ES compared to NQ, and NQ took out previous day high, which is a very strong liquidity level, I will expect a reversal after this SMT has occurred instead of a possible continuation. And we can see that that reversal literally happened, and we dumped 25 points on ES. How many points did we dump on NQ? 109. So you could have used that SMT to either take a short position on ES or NQ, or just have not taken a trade because you're like, hey, we're likely going to go lower. I don't want to be taking a continuation trade after we take out previous day high, which is a very, very strong liquidity level from that liquidity lesson that you learned. And also we have an SMT. So that's two big confluences that a possible reversal can occur. So if we drop down onto the 1 minute, we can look for possible reversal sequences for us to continue lower. So we can see that SMT, what do we have? Change in the state delivery, order block created, trade into the order block, and then we move lower, right? So that is literally a entry model for some people. So let's draw some more SMTs. Boop, boop, boop. I think a very good one is right here. Let me play it out in real time. So I think this one as well. So we can see that the market is consolidating. We can look at ES as well. Let's play 1 bar on ES. Boom, we move higher. What happens when we move higher? We create relatively equal highs with high of day. So we're expecting high of day to get taken out. Boom, high of day is now taken out, right? This is not rocket science. You should already know relatively equal highs, relatively equal lows. So the fact that we created relatively equal highs tells you that this move to the downside, it doesn't really matter. We still want to go higher to take out high day before going lower. Okay, we take out high day. What happens on NQ? We fail to take out high day. Strong as divergence. So what you'd be looking at on NQ is a possible downside trade. And then what happens after that? Boom, lower, 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 and lower, right? Like, you could have caught this entire move to the downside if you knew about SMTs. And then we can look at this huge wick to the upside and then move lower. What happened on ES? ES did the exact same thing. Boom. Let's mark out high day. High day is taken out. What happens on NQ? We don't take out high day, indicating that SMT has occurred, and we can look for a possible reversal on NQ because we want to be shorting the weaker asset and longing the stronger asset. Very, very simple. You don't want to be longing the weaker and shorting the stronger because that's a very, very amazing opportunity for you to get brutally fist. You know, I'm not even going to say it because I want to stay monetized. So like, you don't want to be doing that. We have the divergence. You'll look for a possible entry sequence. You drop down onto the 1 minute. What do? Changing the state delivery right there. Trade into the order block, continuation lower. It really doesn't get more simple than this, and you should be able to see this in real time and see, hey, this is actually making sense. And the fact that we have this divergence indicates that there is a large seller in the marketplace trying to hold NQ to the downside. And the fact that we have this large seller kind of tells you that me and you, we can't move the market. The only person that can have this level of weight and his nutsack is weighing this much to the point where he is causing a divergence and creating a lower high on ES or on NQ, and then a higher high, a higher high on ES tells you that someone with a big ass nutsack is creating a short position on the NASDAQ right here. So I want to be positioned with him. Okay, let's look at this low right here. Boom. All right, let me go to, firstly, we can see that this huge move to the upside was caused by this low right here. Okay, let's just put it out there. We know that. Let us go back over here. Before we had that huge move to the upside, we can look and mark NQ out. That low is created on NQ. Let's look at ES. ES created a lower low. What is that? SMT divergence. What do you want to be doing? Whoops. What do you want to be doing? You want to be longing the stronger asset, shorting the weaker. What is the stronger one? I actually want you to answer this in your head. The stronger one should be NQ. Why is that? Because it's creating a higher low. Boom. We haven't taken out that low on NQ yet, indicating that it is the stronger asset. So you should be looking for longs on NQ. And then let's go on the hourly chart, for example, and let's see this play out. Boom. Right? Very, very simple. Very simple stuff. Okay? Now let's keep this in our head. 95 to 97% of large moves higher or lower, and SMT has occurred before then. So let's look for another one. We can mark out our liquidity levels. What is our liquidity levels? Low of day, high of day, session lows, session highs. Let's mark it out. This is London lows, and then this is low of day. Boom, boom, boom. What happens? Okay, we go higher, take out high day. We move lower, take out London lows, okay? Let's look at NQ in this. What happens here? Let's mark that same low on NQ that we were looking at on ES, that ES took out and NQ didn't. Boom, ES took out London lows, NQ didn't, indicating SMT divergence. What also occurs when we trade into London lows? We can see fair value gap. Boom, okay? And then a possible move higher is what you'd want to be looking for because we have an SMT, we're trading into a fair value gap, and NQ is the stronger index. What happens? We have that move higher. All right. It's really not rocket science. It's very, very easy to see this in real time and predict that the market is going higher or lower depending on the framework that it gives you. Now, let's do another one. We can see that the market moved lower, and we also know that 95 to 97% of large moves higher or lower have an SMT. Okay? What happens before this large move to the downside? We can look at ES and mark that same high out, or even previous day high. We can also just mark out previous day high right here. Boom. And let's look at ES. What happens on ES compared to NQ? During this move right here, ES makes a higher high, NQ makes a lower high, indicating weakness on NQ, and you should be looking for shorts and favoring shorts on the NASDAQ compared to S&P 500. Boom. We take out the high on ES, fail to take it out on NQ. We move lower. Strong reaction after that high is taken out, indicating what? That the SMT is holding. When we have a reaction like this, where we move aggressively after having an SMT, that tells us that the SMT is holding. So what is created afterwards? We have fair value gap, price trades into the fair value gap, continuation lower. And you can also use this for intraday price movement, like this consolidation zone. We have low of day marked right here. Now, first off, this is a barcode. We all know this. So let's zoom in on ES. Let's mark that same low that was created on ES right here. Boom, mark it out. ES fails to take out the low, NQ doesn't. Right after that occurs, let's go over here and go on the 5 minute because the 15 is just way too barcodey. Right as we take out that low, huge move to the upside, right? What also happens on boom right here, huge move to the upside, taking out high day. And then again, take out low of day. What occurs after? We have SMT. Failed to take it out on ES, take it out on NQ, indicating ES is the stronger index and long should be favoring that closer towards that SMT level. If it is going to hold, it will hold this low right here. So boom, move higher. All right, let's do one last one right here. I think this is a very good one. So we can see that on that move to the downside that I was talking about in the first SMT scenario, we can see that we traded into previous day low right here. Okay, marking out previous day low, we hit previous day low and we move higher off of it. Let's mark out previous day low on ES as well. ES is previous day low is right here on this day. So what occurs? So we can see that ES failed to take out previous day low, NQ did, indicating that NQ is weaker, ES is stronger, right? And boom, we move higher off of that. Now here is some more sauce that likely no one teaches you. We don't truly move lower on ES or even on NQ until that SMT is broken. So because we have that SMT with previous day low right here, and then this day we take out previous day low, but we don't take out this low right here, indicating that we are still holding this SMT. Until we break this SMT, we will not have volume to the downside. And zooming in right here, until we break it, boom, huge move to the downside has occurred after we break that SMT. So an SMT can be used for two things: indicating a reversal right here. So a reversal, whoops, right here, or indicating a possible continuation if an SMT breaks. No one teaches you this. I've yet to see someone teach a failure of an SMT. If we have an SMT right here, the best case scenario for this SMT is to move higher to high of day, previous day high, and just continue higher, right? The fact that we are failing to do so and we still have sellers in the marketplace and we're chopping like this tells us that prices are getting accepted at these levels. And if we break this low right here that created the SMT, we can have a large move to the downside. And you should be looking for the exact opposite thing for a bullish scenario if we fail that SMT. Now let me show you guys one last one. So we can look at this huge move to the downside, right? What do we know? 95 to 97% of large moves higher or lower have an SMT. So boop, boop, boop. Let's try to find this SMT to train our mind to see this in real time, because if you're able to see it in real time, you can predict that reversal to occur. We can mark out the high right here. Let's go on ES. What occurs? That same high is traded into on ES, filled on NQ, indicating weakness on NQ, strength in ES. You want to be shorting the weaker, longing the stronger. And in this scenario, this is the weaker asset in this SMT. So you should be looking for possible short scenarios. With this, we can drop down onto the hourly chart and look for that same exact sequence in price for a possible reversal. What do we look for? Fair value gap, right? Becomes an inverse fair value gap. Change in the stay delivery, right? Boom. Price trades into the order block and then continues to move lower. And also, you can also look for a potential breaker. This entire thing would be a breaker. And you can see that these levels hold. Let me draw it a bit better. You can see that these levels hold perfectly, almost to a tick, and we move lower off of that, right? So we have the fair value gap right here, becomes an inverse fair value gap. We trade into that inverse fair value gap right here. We have an order block and a change in stay delivery that is created right here. Once we close under this low, So at 10 a.m., boom. And then a breaker is created once we close under this market structure low. So it would be 12 p.m. And we trade into the breaker, move lower. Trade into the breaker, move lower. Trade into the breaker again. And kablooey. It's very, very simple stuff. If you're able to see this in real time, you are able to determine a possible reversal or a continuation in a certain direction. No one teaches you about SMT failures as a continuation confirmation. Everyone looks at them for possible reversals, but instead you can look for them as a possible continuation. All right. So with that, you should know how to spot SMTs and how to spot possible reversals or a possible continuation if we have a failure of an SMT. All right. Now, when you are looking for this SMT divergence, you should only be looking for it when it is paired with a time-based liquidity. What does that mean? We can go back to our liquidity lesson. It is session liquidity. So we are looking for, let's go over here. We are looking for previous day high, previous day low, previous week high, previous week low, previous month high, previous month low. What else? Session highs and lows. So for the session highs and lows, we are looking for Asia highs and lows, London highs and lows, New York highs and lows. Okay, so let me just put that so you can screenshot it. So Asia, London, New York. Okay, you should be only looking for an SMT if one asset takes out a time-based liquidity like a previous day high, previous day low, week high, week low, month high, month low, or a session high or a session low. If we fail to do that, you should not be looking at an SMT. Do not fall into the trap of looking at an SMT just because one asset took out some random low or a random high. Don't fall into that trap. A lot of people do, and I would not recommend it. The best way to, combat that is to just look for session liquidity levels and only look for an SMT if a time-based liquidity has been taken out. And I would say only look at time-based liquidity levels like this and only look for an SMT if a asset takes out a time-based liquidity and the second asset doesn't. All right, simple as that. Don't overcomplicate it. Alrighty guys, so now for the most important aspect of this entire video, the HyperFlow strategy. Okay, I'm gonna assume this is going to be the most watched part of this entire video, so I'll give you guys a show and listen up. So what are we going to be looking at first? Firstly, we are going to be looking for a higher time frame fair value gap to get traded into. Okay, so it would either be 15-minute, hourly, 4-hour, daily, weekly, even monthly. Now, which higher time frame fair value gap will you be looking at? You want to be looking at bullish fair value gaps in a discount and bearish fair value gaps in a premium. You will be looking for longs off the discounted fair value gap and then shorts off the premium fair value gap. This should line up with your draw on liquidity. If it does not line up with a draw on liquidity, you should not even be looking at number one. You know what? Truly for number one, price needs a draw on liquidity to get traded into. If you do not have a draw on liquidity, nothing in this entire thing matters. Then once your higher time frame fair value gap is traded into, you will then drop down to your aligned time frame. Okay, so for the higher time frame to lower time frame alignments, there will be 5-minute to 15-second, right? So if you are looking for a 5-minute fair value gap, you will look for a 15-second confirmation. 15-minute fair value gap, a 1-minute confirmation. Hourly fair value gap, 5-minute confirmation. 4-hour fair value gap, 15-minute confirmation. Daily fair value gap, you'll be looking for a hourly confirmation. Weekly fair value gap, you will look for a 4-hour confirmation. And then monthly fair value gap, you will look for a daily confirmation. If you're looking at a yearly fair value gap, then you'll look for a monthly confirmation. I know I just don't have it here, but like who the hell is trading a monthly chart? Now you will look for an inverse fair value gap or a change in state delivery, breaker block, or a fair value gap for your confirmation on the lower time frame that the higher time frame is holding. If you do not have a draw on liquidity that price wants to trade into, you should not be even looking at a lower time frame or even a higher time frame fair value gap because there is no objective for price to trade into. Your goal with HyperFlow is to look for the market. Let's say we're going higher and higher and there's a draw on liquidity to the upside. You'll look for a retracement into a fair value gap to trade that to the upside to our draw on liquidity over here. Or let's say it's going lower, lower and lower, and there is a drawn liquidity. Let's say this is previous week low. So previous week low. When we retrace, you will assume that our bias is to the downside and we want to trade into previous week low. We have a retracement and then we go lower to previous week low. Okay. Now, this isn't always on previous week low. It can be session highs, session lows, like a daily high, daily low, or even just high day, low day, right? Now, you need a drawn liquidity first, then and only then can you start looking for everything else. So you will then look for a lower time frame inverse fair value gap, changing say delivery, breaker block, or a fair value gap to confirm that we are holding the higher time frame PD array, and you will look to enter in off of that PD array that is created on the lower time frame. When you do that, you will place your stop loss where your invalidation of those PD arrays is. So if you are entering off of an inverse fair value gap, you will look to place your stop loss when we close outside of the inverse fair value gap. So let's say we're going higher right here and then we retrace and boom, there's a fair value gap right here on the 1 minute. We create an inverse fair value gap and then we retrace into it. You will look to enter once we inverse that fair value gap, and your stop loss is if we close back underneath this inverse, not trade below, but if we close below. So your hard stop will be underneath either this swing low or enough to the point where you know that if we trade into this level, we will likely close underneath this inverse fair value gap. And then you will look to target this internal high over here that was created when we traded into the higher time frame fair value gap. And then your take profit is the internal or external liquidity. What do I mean by this? Let's say we are going lower right here. When we have a retracement and we trade into a fair value gap, the retracement low is down here. Okay, you guys can see this? Yes. The retracement low is down there. That is what your target is going to be. And if we have an external liquidity level, let's say previous day low right here, PDL, if we have that underneath this retracement low, then you will look to target both of those lows as your take profits. Either just this low or both of them or just previous day low, right? For both of them, you will look to take a partial at this low and then the partial at previous day low. And for the others, you just take it off full, either at previous day low or this low right here before the retracement. And then the exact same thing for an upside, right? So let's say we start moving lower right here and we have a fair value gap. What is the high that is created during this retracement? All the way up here, all the way up here. So you'll look to target that as your take profit and your internal drawn liquidity. And if there's an external drawn liquidity level, let's say a session high, let's say this is high day this time, okay, high of day, you'll look to target that for your final take profit or your just full take profit if you don't even want to take it off at this high. How you manage the trade is entirely up to you. Now for managing the trade, if price trades into an opposing fair value gap, you will not be looking for a trade anymore. And if you are in a trade, you will move your stop loss to break even. What do I mean by this? Let's say we go lower right here and then we have a strong move to the upside. Let's say there's a fair value gap over here, a bearish one, and then there's also a bullish fair value gap over here. Let's do it right here. If we trade into the bullish fair value gap, the entire move of this bearish fair value gap is invalid until we trade into this internal high and take it out and then create a new sequence for us to move lower. This only happens if we trade into an opposing fair value gap. So if we don't trade into an opposing fair value gap, that sequence in price is still valid. So let's say there is a fair value gap and a lower time frame fair value gap, and there is a, let me change. Okay, so let's say this black one is a lower time frame fair value gap, and then this red one is a higher time frame fair value gap. When we go lower, let's say we inverse this fair value gap. We haven't traded into this higher time frame fair value gap yet. So this sell setup is still valid because we inverse this fair value gap. Let's say we move higher and then we move lower into the higher time frame bullish fair value gap. When we do that, you will move your stop loss to break even. And let's say we don't trade back into it. Let's say we inverse it and trade into it at the same time. You will not take a trade. This is to prevent you from entering into a short setup where we are reacting off of this bullish fair value gap. okay? And this is why I move my stop loss to break even once we trade into a opposing fair value gap. Let's say I'm in a bearish trade, I will move my stop loss to break even once we trade into this bullish fair value gap. And let's say I'm in a bullish trade, I'll move my stop loss to break even once we trade into a bearish fair value gap. Okay, now let's look at some examples. Look first, then leap. Now let's look at some examples so you guys can see it more clearly. What do we do first? We first mark our range from high to low. Boom, high to low. Okay, what do we do then? We mark our bullish fair value gaps in a discount, bearish in a premium. There is a bullish fair value gap right here. What will you do then? Since we are on the 1 hour time frame, we will then drop down onto a 5 minute to look for a hyperflow to trigger once we trade into that fair value gap. Once we trade into this fair value gap, you will then look for a either inverse fair value gap, change in the state of delivery, breaker, or fair value gap for your confirmation that we are holding, and that is what you will take a trade off of. So we trade into this fair value gap and then we move higher. What do? We create a change in the state of delivery right here. So you can either enter in off of the change in state of delivery right as we have that, or you can look to place a limit order once we trade back into the order block. And you can see that we haven't traded back into the order block and we just continue moving higher. If you miss the trade, you will then look for a breaker to get established. Where is our breaker? So we know that our breaker is a this, and so this is our breaker sequence. Where is that? We can kind of mark it out with this high right here. It is right here. Boom. So this is our breaker. Once we close above this, your entry will be off the breaker. So you can see that price trades literally one tick, not even one tick into it, literally at the breaker, and then moves higher off of it. So let's say we enter in off the breaker right there, stop loss under the breaker low. We will target the internal high right here. We can see that it's a 1.24 risk reward. We can also extend that to previous day high right there, which is a 2.24 risk reward. And then let's play this out. Boom. And boom. Let's do another example. We can look at NQ to all-time highs and previous day high. Okay. What happens over here? We have a 15-minute fair value gap. Price trades into that 15-minute fair value gap and then continues higher to all-time highs. Let's go back to see if a hyperflow has triggered during that move higher. We can see that, what are we looking for? Inverse fair value gap, change in state of delivery, breaker block, or regular fair value gap as our last confirmation for an upside trade. And then we will look to target previous day high, which is this line right here. Let me make it a bit thicker so you guys can see. So we trade into that fair value gap right there, consolidate, change in the state of delivery occurs right here, and a fair value gap is created. So there's two confirmations and three. Hold up. I didn't even see this. My bad. Three confirmations because a breaker is also created. So you would have that as your breaker. We have a change in the state of delivery. So your order block is created right there, and also a regular fair value gap right there. So boom, you would enter in off of either one of them. So let's say you enter in off the change in state of delivery order block. Your stop loss is underneath that internal low, and you will look to target either this high right here, the internal high that was created, or look to target previous day high. And this is a 4.32 risk reward trade. If you're looking to enter in off of the fair value gap, you have a 2.65, and if you enter in off the breaker, you have a 3.38. I think the fair value gap you would enter in and have a 15-point stop loss. So 3.68 risk reward, and then the breaker would be 3.38 risk reward. And that is what you'll be looking for every single day for hyperflow to trigger. Now for managing a position, if price takes out the internal high or the low that was created from the pullback, you'll move your stop loss to break even. For example, if we traded into this high, we move our stop loss to break even. If we trade into this high before a setup triggers, you will not look to take a trade anymore because that completes the sequence of price. The premise of this entire model is we go lower, we have a market maker model to the upside right here. So this is our sell side of the curve. We trade into a higher time frame fair value gap, and then we start a buy side of the curve. and you are looking to target a buy side of the curve and then the external liquidity level that's created from this pullback, and this completes the market maker model. So if you trade into that high and a setup forms, then you will not look to take a trade off of it. If you are in a trade, you will not look to take a trade, and if you are in a trade, you move your stop loss to break even. Now for the next trade management aspect of it, if an SMT occurs, you will move your stop loss to break even. Now, where am I looking for an SMT? Not just any random spot, but we are still looking for this internal high as our SMT level. So if we go to ES, for example, and ES takes out the high, we will then move our stop loss to break even. Or if, let's say, this change in state delivery occurs after ES has taken out the high, then we won't look for the setup entirely. So we can see that we don't have an SMT with NQ, but we do have it with ES. Because ES failed to take it out, NQ did. So let's say we were in a position and we were looking for the exact same thing. We have our higher time frame fair value gap right here. 1 minute, drop down onto the 1 minute. We will look for a change in state delivery. We have that right there, and then a fair value gap and also an inverse fair value gap. So let's say we enter in off the change in state delivery with our stop loss underneath that internal low. Okay, boom. Once NQ takes out this internal high level, so right here we can go on NQ, the same internal high that is created before the pullback, we will then move our stop loss to break even. So we can see that we took it out at 9:49 a.m. We can go on ES. Once 9:49 a.m. occurred, we will move our stop loss to break even. Okay, simple as that. And if a trade triggers after that, we will stop looking for a trade entirely. Now, if this is hard for you to grasp, I have created an indicator for my setup. So it gives me buy and sell signals depending on when a HyperFlow is triggering. So we can see that price traded into our fair value gap and then moved higher, change in state delivery has occurred, and then it gives a buy signal off of that. And I would look to target previous day high from that. And in this scenario, it was a sexy ass trade to the upside. And once previous day high is hit, we will stop looking for a trade entirely because our objective has been hit. Once an objective is hit, we stop trading for the day because there is no higher probability setup that will likely trigger. If we do take out an objective and then we have large volume to the downside, then and only then will I look for a trade, let's say a short off this to low of day, or not even low of day, New York low of day or actual low of day, or I will just not look for a trade entirely and just step away because I have taken my piece of the pie during this day. I don't need to look for trades every single second of the market moving. I can just look for this sexy ass trade to the upside and then be done and not have to look at the market. We do this for freedom, not to be slaves to the marketplace. All right, for another one. So we have a fair value gap right here. Boom. Mark that as fair value gap. We have this internal low that needs to get taken out for us to reset the sequence and actually start a move higher. In this scenario, we have ES right here. Boom, we go lower, take out this internal low. What happens on NQ? Once we do that, we take out low of day. Boom. So let's go on the 15 minute. We take out low day on NQ and then fail to take it out on ES, indicating strength on ES, weakness on NQ. We want to be longing the stronger index. And since we have an SMT into a higher time frame PD array, this makes this setup a plus. So we will then be looking for inverse fair value gap, change state delivery, breaker block, or a fair value gap for our entry. So we have a change in state delivery all the way up here. We have a regular fair value gap over here. Once we inverse this, then we can look to take a position. Boom. We can see, okay, we're consolidating. Boom, inverse has been created. We will enter into the trade right there. Stop loss under either the swing low or wherever you think your invalidation level is. So let's do 5 points in this. And then we will look to target high of day. Do we have anything else? I think we have previous day high that wants to get traded into as well. Where's previous day high? No, we already traded into previous day high. So let's just target high day, okay? Because we have relatively equal highs, we can see that this is accumulation, manipulation into our higher time frame PD array, and ideally we want to see distribution to the upside. What happens after that? Boom. And completion. Now in this scenario, we don't trade back into the change in state delivery. We do trade into a fair value gap right here. Boom. Right? So over here, if you didn't enter in off of the inverse fair value gap down here, or yeah, we don't even trade into the breaker. You would look to enter in off of this regular fair value gap as your final confirmation that, hey, we will likely go higher to high of day, and yeah, literally high of day. So you would look to target high day, stop loss underneath your fair value gap, okay? And this is a 2.31 risk to reward trade. Let's do some more. All right, this is going to be a good one. We have a large move to the downside right here. Boom, boom, boom. What is created? Fair value gaps. So let's mark out our fair value gaps. And then we have relatively equal lows with this low over here. We will look for price to trade back into a fair value gap to continue lower to this low over here, as that is our objective. Okay, we create more relatively equal lows. Fair value gap created. Let's drop down onto the 1 minute because that is my aligned time frame. I was on the 15 minute for my higher time frame fair value gap. Fair value gap has been created. Let's look for price to trade into it. Once we trade into it, then I will look for my stuff. It is a change in state delivery, inverse fair value gap, breaker, or regular fair value gap. We can see a change in state delivery has occurred. We can look to enter in off that short and then stop loss above the high. Look to target that low, that swing low down there. You guys can see that, yep. And that will be our trade. Boom, entry. We get stopped out on that one. Cost of doing business. Create another change in state delivery. Your entry is off the order block over there. Targeting this low right here for 4.15 risk reward trade. Boom. So you took one loss and then one win, equaling 3.15 risk reward. If you risked $100, you made $315. Yippee. Okay. Now, if you entered in off the inverse fair value gap, you would enter in right there. Boom. Because we have a regular fair value gap right here. And we inverse it on this candle over here. Entry off of the inverse if you are looking to trade the inverse. And then you have a 1.88. But ideally, you want to have a minimum 2-to-1 risk reward trade. Okay. And then whatever. It just does nonsense. And you can see right as we trade into that objective, we have a strong bounce, and you don't really want to be in a trade after that because your drawn liquidity and objective have been traded into. Now, in that same scenario, you can look for this hourly fair value gap. Price trades into that hourly fair value gap. What happens after that? Boom, boom, boom. We have a regular fair value gap right there. We inverse that fair value gap. Your entry in is off the inverse. Stop loss above your internal swing high and your invalidation of the inverse, and then you can look to either target that same low on the NASDAQ right there for a sexy ass 6.57 risk reward trade, or even just target previous day low for a 2 risk reward trade. Now, let's say we are all the way up here. The probability of us hitting this low, kind of low in my opinion. Like if we're up here, I'm not looking at this low. Instead, I'm looking at this low or this low as my drawn liquidity and objective. And I won't be able to capture the entire move, but I can capture a decent chunk. So a 2.11 or a 3.14 risk reward trade can be captured. Now, this happens on every single time frame. So let's do a monthly to daily one. So boom, monthly fair value gap. Price trades into a monthly fair value gap during the tariff thing that everyone was like, oh my God, we're going to crash. What happens? We move lower, go higher, change in the state of delivery right there on what? This candle right there. Entry off that. Stop loss is underneath an invalidation of that. And then you look to target all-time highs or a 2-to-1 risk reward, and I guess you'd still be in this trade. But this is why I don't look to take like monthly to daily trades, because I just don't want to be holding for this long. But yeah, like it's really just not my style. We can also look for this daily fair value gap, for example. Let's go back. What are we going to look for? Hourly, because it is a daily fair value gap. Boom. Once price trades into that daily fair value gap, then and only then will we look for our entry confirmation. We have relatively equal highs as our drawn liquidity. So that will be our take profit number 1, and then take profit number 2 can be external draws on liquidity. What do we look for? Inverse fair value gap. Price creates a regular fair value gap, and then we inverse it. You can either enter in off the inverse right there, have a bottom tick, or you can just enter in right as we close above the inverse, and then your stop loss is underneath that inverse fair value gap. You look to target at least a 2-to-1 trade. Boom, 2-to-1 is hit. Let's look at a 4-hour to 15. So we have this 4-hour fair value gap right here. Boom. Price trades into that 4-hour fair value gap and then moves higher. We can also see relatively equal highs. Actually, you wouldn't really take that because we took out the high. So let's just look at this 4-hour fair value gap. I can guarantee you a 15-minute hyperflow triggered to the upside. Price trades into this 4-hour fair value gap. What happens? Change in state delivery occurs. What also happens? Inverse fair value gap. Right as either the change in state delivery occurs, you can either market enter in or place a limit order off the order block. We can see that we don't get tagged in off the order block if we are looking for that. So then afterwards, you would be looking for this inverse fair value gap as your entry. Right as we have that inverse, you look to enter in. Stop loss underneath that inverse fair value gap right around here. Yeah, it would be around here. And then you would look to target the internal high for a 2.76 or even this high right here. Whoops, what happened? Yeah, previous day high. Boom, previous day high is hit. 3.77 risk to reward trade, just like that, right? It's kind of simple. When you see this so consistently every single day, like, trust me, you will milk the market with this. I'm going to be dead ass. All right, let's look for another one. We have this 15-minute fair value gap right here. Boom, price trades into this 15-minute fair value gap and then moves higher, okay? We can also mark out this bearish 15-minute fair value gap. We drop down onto the 1 minute right here. What are we looking for? A change in state delivery, inverse fair value gap, or a breaker block, or a regular fair value gap, okay? So we can see a change in state delivery occurs, price trades into this order block and then moves higher off of that. But what also happens, if you were paying attention, you would probably have noticed that we have traded into an opposing fair value gap, which is a bearish fair value gap right here. Boom. So because we traded into this bearish fair value gap after this setup occurred, this entire sequence is now invalid. Even though the setup might be sexy, this is how I prevent myself from entering into bad trades and getting chopped up in the marketplace. So I will follow my rules no matter what. If you want to have that rule, you can have it. You don't need to have it, but this is what I use. So we can see that we go higher, boom, and we complete the hyperflow and trade into this high right here. Would you have made money from this trade? Yes. But would you have broken your rules to make money for this trade? Also yes. So you're hindering yourself back just to make profits on this particular day. This rule has saved me thousands and thousands of dollars. So if it hits once out of 10 trades, I won't look at this one time that it hits thinking, damn, I should look to break my rules next time because we hit this sexy ass trade when it got invalidated. Instead, I will look at this and say, hey, it is what it is. This is part of trading. I won't be able to capture every single move. My goal is to capture a portion of it and have the highest probability of winning on that trade and capturing that move. So this would have been a no trade right there. So let's do another one. We can see that price moves lower on an FOMC day, trades into this 4-hour fair value gap and also this 4-hour fair value gap. Boom. We can drop down onto the 15-minute right there. What happens? Once we trade into that 4-hour fair value gap, we have a change in state delivery, a bullish fair value gap, and also a breaker is created once we close above this high. So your entry would be off the breaker right here. Stop loss underneath the breaker low, looking to target the internal high or 2-to-1 risk reward. 2-to-1 is right there. Boom. And boom. 2-to-1 is it. Perfectly. And this is the power of hyperflow. This happens on every single time frame, every single market condition. Okay, like Bitcoin, for example. If you look at Bitcoin and a weekly chart, we have a weekly fair value gap right here. Price trades into a weekly fair value gap. Let's go back. What do we look for? What is our time frame alignment? Let's go back. Boom. Weekly to 4-hour. Let's go back. 4-hour. Once price trades into this weekly fair value gap, we will look for inverse fair value gap, change in state delivery, breaker block, or regular fair value gap. We have a regular fair value gap right there. Inverse has been created. Entry off the inverse, stop loss underneath this internal low. Look to target that internal high for 2.46 or even higher if you want. Let's do a fixed one of 3-to-1 risk reward and let's see it play out. Kind of slow. And there it is. Now you might be wondering, hey, did we fail on this one? Right? We traded into that weekly fair value gap, moved higher. Did we fail? No, we didn't. So we have that inverse fair value gap. You enter in off that, stop loss underneath the inverse. Once we trade into an internal high right here, you move your stop loss to break even. Or if we trade into 1-to-1, 2-to-1 risk reward, you then move your stop loss to break even. Gone stopped out break even for the rest of your position had you had not taken profit at 3-to-1 risk reward or a 2-to-1 risk reward right here. But worst case scenario, this would have been a break even trade. And you can see that if I go to my HyperFlow indicator, put 20, go to weekly, and because I am on the 4-hour chart, we can see this play out in real time. Does it give a buy signal? Yes, it does. Gives a buy signal to our take profit, which is the HyperFlow high, aka the high that was created before the pullback for us to continue higher. Okay, I think I have a time window selected. My bad. It didn't show this buy signal. So it gives this buy signal over here, and then this would have been a break even. We move lower, reset the sequence by taking out this internal low down here. Boom, a new sequence has been created. Fair value gap, inverse fair value gap, gives a buy position off of that to continue higher. Now you guys might have noticed I have created my own indicator off of my model. Okay, it is called the HyperFlow indicator. The reason I created this is so I can stop thinking and let the indicator just think for me. The more you trade, the less you want to start thinking about the marketplace, I'm going to be honest. So that's why I created my own indicator and my own algorithm to tell me where the setup is triggering, basically. So we can see a weekly to 4-hour has triggered right here. And we can see every single setup that I was talking about, like this 15-minute to 1 minute. We can go on 15-minute, put this on the daily, enable SMT, enable this. Does it give a buy signal? Yes, it does. Boom, buy signal, entry, stop loss, take profit, bada bada boom, pow. If you are interested in the indicator that I've coded around my model, it will be linked down below with a video instruction tutorial on how to get started. So let's just go back to our breakdown again. We will look for a higher time frame draw on liquidity to get traded into. Then and only then will we look for a higher time frame fair value gap to get traded into. So it would be either a 15-minute, hourly, 4-hour, daily, weekly, monthly, whatever. Then once price trades into that higher time frame fair value gap, we will then drop down onto our aligned lower time frame. So right here, boom, 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 boom. Then look for a inverse fair value gap, change to a delivery, breaker block, or a regular fair value gap for confirmation that the higher time frame fair value gap is holding. We need confirmation that the higher time frame fair value gap is holding, and until we have that, we cannot take a trade. Once we do have that though, then I enter in on my trade and place my stop loss where my trade idea is fully invalid. If it is underneath a swing low or above a swing high, then that's where my stop loss is. If it is under an inverse fair value gap, a breaker block, a order block, or a regular fair value gap, that's where my stop loss will be. But it is always where my trade idea is invalid. Then I will look to target internal or external liquidity. The internal liquidity will be the high that is created before the retracement or the low that is created before the retracement. And then for external liquidity, I will look to target previous day high, previous day low, or any session highs, session lows that is near this internal draw on liquidity. Okay, and then if price trades into an opposing higher time frame fair value gap, then I will stop looking for a trade. For example, if I'm looking for a bullish 1-minute trade, I'll be looking for a bullish 15-minute fair value gap. If we trade into a bearish 15-minute fair value gap before giving a signal, then I will not look to enter in off that trade. If we trade into that bearish fair value gap after I'm in that trade, I move my stop loss to break even. If we take out that internal high that I was talking about right there, or the low that's created from the pullback, I will move my stop loss to break even. Or if we take it out before a change state delivery or inverse fair value gap, breaker block, anything is created, then I will not look to take that trade entirely. If we have an SMT with that internal high, so if ES takes out that high and I'm trading NQ, then I will not look to take that trade, or I will move my stop loss to break even if I'm in a trade, okay? If I'm trading Bitcoin and the total market cap takes out that internal high, then I will move my stop loss to break even. If I'm trading Bitcoin, then if Ethereum takes out that internal high, then I move my stop loss to break even. If I'm trading gold, then I'll look to move my stop loss to break even or not take the trade if silver takes it out. If I'm trading Euro USD, I will not look to take the trade or move my stop loss to break even if DXY takes it out. Simple as that. I will only look to take a trade between 9:30 a.m. to 3 p.m. Eastern Standard Time because I look to only take day trades. And if an objective is hit, I will stop looking for trades entirely. Unless, let's say, NQ takes out our objective, which is previous day high or high day, ES fails to do so, and when it does fail to do so, it trades into a higher time frame fair value gap, which is a SMT, and we react off that higher time frame fair value gap on ES to move lower. Then and only then will I look to take a short position after that. But with that, you should now know my setup. Holy crap, this is long. So now let's start talking about backtesting and how to backtest a strategy. What I use for backtesting is Notion. I would recommend you to use Notion as well. You can use another backtesting software. It's entirely up to you, but I find Notion to be the easiest, and I learned the most from it because I'm manually putting in all this information. So when I type it out and I see the data that I'm typing out, I'm able to absorb it a lot better than just doing it in a regular software where I can just click a button and it does everything, calculates all my data for me. So what I do is I have the ticker right here, the date, the hyperflow that is triggering, 15 minute to 1 minute, 5 minute to 15 second. If it's like an hourly to 5 minute, I have it over here. Day of the week. These give you a very good insight as to which days of the week you are most profitable and you are least profitable. Because if you are consistently not profitable on a Monday, for example, that's probably because right after the weekend, you're trigger happy. You couldn't look at the market for 2 days and you now look at it and you try to force something that isn't there. So using this information, you can maybe look to take risk off on Mondays because you realize that it is your least profitable day of the week, or it could be Tuesdays or Thursdays. It really depends for your style and your strategy. So if your strategy just doesn't thrive the best on Fridays because Fridays usually pulls back to the weekly range and you're a continuation trader, then you can look to be risk off on Fridays. And if you are a reversal trader and you see that reversals trigger more times than not on Fridays, then you should be risk on Fridays. Then I have a time slot so I know exactly which time period per hour I know is best for me, right? Then I have an RR section so I know what the RR is for the trade that I'm taking. And then I have another notes right here. So this one, for example, 3.27 triggers on a Wednesday, 5 minute to 15 second. Let's open it. I also have an attached screenshot so I know what to look for. For example, boom, 5 minute fair value gap, price trades into that 5 minute fair value gap, gives the buy signal. Then I target what? This high of day liquidity right here, boom. Why would I not take these sell signals right here? Because we have a high of day objective instead of a low of day objective. And then I don't take this trade over here because what happens, we already took out our objective for the day. Even though this hits, I know that's not part of my plan. And what I do is I don't try to inflate my results in a backtest. In a backtest, you might be looking at it thinking, hey, I might have taken this. Try to be as emotionless as you can with the backtest, and you know your personality the best. What you should do is before taking a trade, would you look at the trade right here and think to yourself, would I take this in real time? If the answer is no, you should not be taking it in a backtest. Simple as that. So with this, I also calculate the sum of my RR of the entire month. So this one was a 31.61 risk reward month. Scroll up. June was a right here. Yeah, June was a 30.17. Scroll up more. April was a 76. Scroll up more. March was a 41. So I'm averaging at least a 30 R per month. With this, we can pull out our calculator and do 30 with a multiplier. So if I'm risking $100 per trade, I make $3,000 per month. If I'm risking $1,000 per trade, I'm making $30,000 per month. This is the most beautiful thing about trading, because if your RR is profitable and you have a profitable strategy, the best way to make more money and make 10 times as much more money is to add an extra zero to your position size, or twice as much. You just increase your position size by 2 times. It's really not that hard to make more money. The hardest part is to make money. Once you are consistently profitable with a small amount of money, you can look to scale that infinitely. That's the best thing with trading. It's not like any other business model where you have to put in twice as much work or 10 times as much work to get 5 times as much profits. Instead, you do less work and just increase your number. It's so stupid. You just increase your position size by 2 times, 5 times, 10 times, and you're making that much. Granted, you're also losing that much, so you should be able to withstand that risk that you are putting onto the table. But granted, you also lose twice, 5 times, 10 times as much. So if you are unprofitable, it's not viable for you to look to increase risk. Instead, you should keep your risk super, super minimal. And then once you have a small amount of money that you're making, you can look to exponentially increase that. You don't really want to be increasing your risk, because if you're not making money and this is your P&L curve, your P&L curve will just go down more drastically. Simple as that. But if you're not making money and your risk is very, very small, you're only going to be losing a small amount of money compared to someone that's over leveraging and over risking when they're not profitable. You don't want to be down here. At least when you're not profitable, you're still down there, but like you're kind of up there. You feel me? And then throughout your day trading journey, you're just getting a little bit more profitable over time. Boom, 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 boom. And then when you know you're profitable, then and only then can you look to really increase your risk. And this right here is just this zoomed out, right? All you have to do, increase your position size if you want to make more money with trading. So with backtesting, I would highly recommend you go on Notion, you create a table, and with every trade, you look to add a screenshot to that. Right here, boom, you can see every single one of these trades has a screenshot attached to it, because, boom, right here, like this buy position, just so I can look back at this and see, hey, I know if this setup failed or not, and I have proper data that is collected on it. And the fact that I'm not inflating these results means that I can actually achieve these results by myself with actual trading. And then what you do is you go on TradingView, boom, you go on your replay, right here, boom, right here. Once a, let's say 15-minute fair value gap is traded into, you drop down to a 1 minute, boom, change state delivery, or you just look for that buy signal, and then right here, boom, boom, boom. Like, you just play it out, or wherever it is, I don't know where it is. And then you just play it out, and once that is done, you take a screenshot of this entire thing, boom, screenshot taken. Did you guys see that? I don't know if you guys even saw that, but boom, screenshot taken. And then you put it in your Notion saying, hey, this is what I took. What was the setup? Put your comments right there. XYZ setup, blah, 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 blah. But that is how you backtest and give yourself proper data for you to look back and analyze. The reason you backtest is so you have proper data for you to make decisions on, right? So it gives you data for what your take profit should be. It gives you data for what your stop loss should be, what your entry should be, what your risk should be, right? I'm going to be going into risk management on the next segment, but it should also be telling you how much your risk should be. Because if you are losing multiple times in a row, let's say you lose like 5 or 10 times in a row, which is insanely high, but let's say you do, that tells you that, hey, maybe I should look to risk less on my setups, because if I risk $1,000, am I able to withstand mentally $10,000 of drawdown if I lose 10 times in a row? Likely not. And then it also gives you an idea if your strategy is profitable or not. If it's not profitable, throw it in the trash entirely and then look for something else or tweak it to make it profitable. But that is how you backtest. That is the premise of backtesting. You should be backtesting every single weekend if you're not profitable and looking to make your strategy better, your risk management better, and your psychology better. Because when you have the data right in front of you and you're like, yo, I know this is profitable, in real time, let's say you take a trade, you will be less emotional on that trade because you have backtested it. If you don't know the data behind a certain strategy, you will likely be more emotional to it because you don't know if it's gonna hit or not. So let's say a trade hits, you're like, oh my God, let's go. But let's say you backtested that setup and a trade hits. You're like, okay, I've seen this. It's just part of the statistic. The end of the month statistic will likely result me 30R. Why am I getting excited for 2, 3, 4, or 5? Huh? You shouldn't be. It gives you proper expectations on what you should be looking for, and it gives you a very good idea to manage your trades, manage your emotions, manage your psychology, and just trade 10 times better. So it seems like I forgot to tell you how to journal all of your trades. When you take a trade, you should be journaling. The power of journaling is the most important thing. In my honest opinion, if you're not journaling your trades, you're not trading, you're gambling. Because as traders, we collect data and make informed decisions depending on that data. If you do not have data that you're relying on, you're going in blind, and in my honest opinion, you're just gambling. And you're treating trading like it is a side hustle, and that's all it will ever be. You will not be profitable until you start journaling. So how do you start journaling? The easiest one is on Notion. What you do is you go to the marketplace over here, search up trading, and then you can go through any one of these trading journals. I created a template of this guy. It seems okay. I personally have my own journaling template that I will be linking down below that you guys can use if you want. But looking at this journal, like it gives the P&L, it gives your, like it also gives a chart over here. I don't know why it's not showing up. And it gives you your journal right here, and you can like go through everything. It gives you symbol, entry time. It gives you your account so you can see which account you're trading, entry and exit date, symbol, model. It gives almost everything. The only thing that's meh about this is that this is kind of curated for Forex instead of futures. So but aside from that, it's pretty decent. So it has even a watch list. Holy crap, trading summary. This is my first time seeing all this daily trading psychology. So you can like have a psychology journal inside this as well. And then it also has leaderboards with which models trade the best, which instruments are the best, type of trades. Holy crap, this is actually pretty good. With this amount of data, you can look at it and make informed decisions upon this. Like for example, if USD CAD or ES or NQ is your top performing asset, that's the one you'd likely want to be trading. And if let's say YM or some other asset is your worst performing, or Bitcoin or anything is your worst performing, then you kind of want to steer away from that, because you know your strategy thrives more on ES, NQ, whatever your top asset is, and then type of trade, short term, long term, swing, trades. With the model over here, you can also see which strategy trades the best for you. Some strategies might be terrible for you, some strategies might be amazing for you. For example, my own strategy that I just showcased, it might not be amazing for you. It's not that hard to incorporate, but it just might not be the best for you, like psychologically. And then accounts, however many accounts, which counts up the most, entry time frame. This is actually pretty good. Like it has a lot of things. I'm actually surprised by this. So boom, how do you journal? Like literally go through every single one of these: narrative, your bias, market conditions, type of trade it is, session, entry time frame, confluences, entry signal, order type, if it's a limit or a market order, you feel me? Position, your stop loss, how much you're risking on the trade. It gives you amazing data that you can collect and make informed decisions upon. Because if you're not using your journal to collect data and make informed decisions upon that data, you are gambling, in my honest opinion, right? Boom, yo, this is actually sexy. Like, bro, this is actually insane. And then entry screenshots, exit screenshots, mistakes, lesson learned, status, open or close. This is pretty good. This is actually pretty good. But yeah, that is how you journal. With every trade you take, you should be journaling that trade, whether it is a winner or a loser. The best thing about losing trades is when you put it into your journal, you can learn from that. Instead of looking at a losing trade like, oh, I don't really care about this trade, I don't want to think about it. Instead, think about it more. See what went right and see what went wrong, and then try to replicate what went right, and then try to get away from what went wrong. If you took a trade during a time window that you don't usually trade, for example, London session, you took a trade during then when your strategy thrives during New York, that gives you key information to tell you that you should not be trading this session. And another thing is, if it hits during London session and you realize that your setup is even better during London session than in New York or Asia session, then you can look to increase risk on London session, or you can only trade London session, or you can like trade both and make double as much. You only make these decisions when you journal, when you look at the data right here and you're like, And if you're not doing that, you are cooked. So now let's start talking about risk management. How much should you be risking per trade? Let's say, let's zoom in here. Let's go all the way up. Let's say you have a $100,000 account, right? Now, I'm just saying this number for easiness sake. If you have 1% risk per trade, you will be risking $1,000. With this, you can lose 100 times, and then and only then will you lose your entire account. So if you lose 100 times in a row, then and only then will you lose your account. Now, the probability of you losing 100 times in a row is almost zero, but ideally you want to be risking around 1% of your account size per trade. Now, this doesn't account to a lot of money if you are trading a small account. For example, if you're trading a $1,000 account, how much is 1%? $10. With that, you're not really making a lot of money, because let's say you have a 1 to 3 risk reward trade, a decent trade, okay? If you're risking $1,000, you make $3,000. But if you're only risking $10 on this 1 to 3 risk reward trade, how much do you make? 3 times, which is $30. It's not a lot. It's not really a lot of money. So when people are trading small accounts, they see, bro, I'm just up $30. What the hell? Even though they took a good trade, they only made $30, which discourages them and has them entering into bad trades to make more money. Because if you're only up $30, you're like, yo, let me make like $70 more or $20 more because I want to be up 50 or 100. $100 day, that's not bad. But $30, so ideally you want to be risking around 1%, 2%, no less than 5 or 10%. If you're trading a $1,000 account, which is considered a small account, you should maybe risk 5 to 10%. It's entirely up to you and what you can really withstand. If you can't withstand $100 of risk on the table and you can't bear to lose that $100 in a $1,000 account, you shouldn't be risking $100. A lot of people, they see, yo, I only have a small account. I want to make $10,000 or $5,000 with this $1,000. So they look to over leverage, over risk. And because they're doing that, they're not looking at the downside risk that they're taking. So if they're trying to make $5,000, $2,000 with this $1,000, they have to be risking $200, $300, $400, even $500, which is 50% of this $1,000 account balance. Should you be risking 50% of your entire account size? Hell to the no, because if you lose 2 trades in a row, you're cooked, you're gone, you're out of the game. The market has taken your money. So ideally, you want to have a big enough cushion to the point where you can survive. And especially when you're starting off, you can take enough paper cuts and learn from them and still have your account. Your goal when you start off isn't to make $1 million starting off, but instead it's to learn the strategy, learn your psychology, and also perfect it. So let's say you are risking only $10 per trade. You're not looking at it in an aspect of, I'm trying to make $1,000, I'm trying to make 10,000, whatever. You're looking at it as an aspect of, I am learning using these $10 instead of I'm trying to make money from it. Then the entire account size of $1,000 is being used for you to learn trading, for you to learn your own mind and excel in the future. Because if you're risking 1% of $1,000, how do you look to scale that higher? Boom, you just add an extra zero, now you're risking $100. Add an extra zero, now you're risking, now you're risking $1,000. And since you're doing the same exact thing, if you're profitable with $1,000, you can be profitable with 10,000, 100,000, and your gains just exponentially increase. So if you're starting off, I would highly, highly, highly recommend you start off with a small account size. And if you don't want to trade live money, start with the demo account or start with the prop firm account. You should not be looking to put your life savings when you just start trading, okay? I've seen a lot of people do that. They lose their entire life savings and they're like, bro, what the hell do I do now, right? Like they have no money left over. And let's say you learn the skill set of trading and your life savings is $50,000. You lose all $50,000 and you have $1,000 left to your name. Let's say with that $1,000, you learn the skill set of trading and you have proper risk management and you follow your rules and you're disciplined. What happened to that $50,000? That money could have been used for you to scale your account more and more, but instead you wanted to make money right now. What you could have done is just put $1,000 in, learned the same exact thing, lost the entire 1,000, and then the next 1,000 you finally get the skill set of trading, and you still have $48,000 compared to the version of you that just spent that $50,000 and started to do some stupid stuff with his account. Now with trading, there is a thing called risk to reward. With the strategy, you will not have a 100% win rate. So don't try to be right 100% of the time. If you're right 50% of the time, that is pretty good. Okay, you might think that's terrible, but that is actually a good statistic. If you're right over 50%, that's amazing. So if you are right 20% of the time, how do you make money? If you have a risk to reward ratio of 1 to 1, 2 to 1, or a 3 to 1, you will not make money. If it's 4 to 1, then you'll be break even. And if it's a 5 to 1, you'll be semi-profitable. Let's say you have a win rate of 40%. If you have a risk reward of 1 to 1, which means if you risk $100, you make $100 per trade on average, you will not be profitable. If it's 2 to 1, 3 to 1, 4 to 1, or 5 to 1, or anything above 2 to 1, you will be profitable because the math says so. Let's say you have $1,000, you're risking $10 per trade, and you take 100 trades. Each trade results in a $20 win on average, and each loss is $10 because you're risking $10. So with a 40% win rate, you have 40 wins, 60 losses. So we can do 40 times 20, which is $800, and then 60 times 10, which is $600. 800 minus 600 is $200. You have made $200 of profit with a 40% win rate. Now, let's say you increase your win rate to 60% and your risk to reward stays the same with a $20 average win and a $10 average loss. Let's do the calculation. With 100 trades, you win 60 of them, so 60 times 20, and you make $1,200 and you lose 400, which equates to 800, I believe. With the 40% win rate, your total profits was $200. With a 60% win rate, your total profits are $800. You have quadrupled your profits with a 20% increase in your win rate. This is the power of risk management and trading. So ideally, you do not want to be over leveraging. You do not want to be over trading and taking bad setups. You want to be taking setups that align with your system, and you want to have a positive risk to reward and win rate ratio. If it is anything inside of this entire, let me make this white. If it's anything inside this entire red area, you won't be profitable. If it's anything inside of the green area, you will be profitable. And if it's yellow, you will be break even. This comes down to data collection. You will not be able to see this until you collect your own data. So 100 trades, for example, you won't know what your statistic is, like your win rate or your average risk to reward is, if you don't collect that data. And if you don't collect it, you are going in blind. It's literally like walking in a desert filled with mines without knowing that it's filled with mines, and you're just like strolling, chilling, like you don't know what's going on. That's literally what you're doing. Can you go through the entire desert without getting kaboomed? Yes, but the probability of that happening is also high. So you'd want to go around those areas where you know there's a mine. Bro, that was an insane analogy. And then with TradingView, if you go onto the risk reward tool right here, you can literally put in your risk right here. So risk $500 or $100. And if you look at the quantity right here, I can't zoom in more because like this doesn't zoom in. But if you look at the quantity, you should be watching that right now. I'm going to put this to $200 and watch the quantity change. So where my mouse is, 200, enter, 0.145, 500, 0.364 with a stop loss of 68.75. If I look to minimize this stop loss and I guess tighten it, you can see that my quantity increases. With my quantity increasing, my risk stays the same. Why is that? Because with a tighter stop loss, I can have more contracts in the market and have the same risk, like dollar risk, in the marketplace. For example, 24.5. If I'm risking $500, 24.5, I will have one contract. If I'm doing 50 points, I will need to do 5 micros. If I'm doing 75 points, I will need to do 3 micros. So TradingView gives you an amazing risk calculator built in, so you don't need to go to some external website to calculate your risk. It's all done for you. As long as you just put in the risk number in USD or percent. I usually just do USD and then just put it to like 500, 1,000 or 2,000, or whatever your risk wants to be. But if you don't have a lot of capital, don't be discouraged because you can trade prop firms. So now that we've talked about journaling, we can start talking about prop firms. In my opinion, if you are profitable or unprofitable, prop firms have the best return on investment. If you don't know what a prop firm is, it is basically you pay money to a company and pay an evaluation fee. Once you pass the evaluation and tell the company you actually know how to trade, they give you their capital to trade with, and you can look to scale that. With the money you make from that capital, they give you a percentage cut. Usually it is a 90-10 to 80-20, and 90 and 80 are in your favor, 10 and 20 is for them. So the ones I'll be discussing are TopStep, Apex Trader Funding, Tradeify, MyFunded Futures, and FundingTix.com. So if we go to TopStep and scroll down, we can see that we can get an evaluation of a 50K account for $49 per month. With this, once you pass your evaluation, you will pay another fee to activate your funded account. Now, these funded accounts are not actually the prop firm giving you capital 99% of the time. It is simulated capital, so don't think of it as, oh, you actually have this 50K. Instead, think of it as an opportunity to make money using these accounts. So an all-in cost for a 50K account is $49 plus a $150 activation, which is $200. A 150K account is $250, and a 150K account is $300. With this evaluation, you have a profit target of $3,000 and a drawdown limit of $2,000. If you lose $2,000, you fail the account, and if you make $3,000, you pass the account and have a funded account. With a funded account, once you pass a certain threshold, you can then look to withdraw that capital. So for example, with this 50K account, you can possibly make $5,000 with a $200 all-in cost. Now for Apex Trader Funding, let's scroll down. Don't even look at wealth charts plan, like that's dookie water. You'll be looking to trade Rhythmic or Tradeivate. I would recommend Tradeivate because it is the most beginner friendly, and since you are a beginner, go for that. For their plans, they have a lot of account sizes, a 25K all the way up to a 300K. Now, the 25K is easiest to pass and easiest to get a payout with. The 300K is hardest to pass and hardest to get a payout with. I'm going to be honest, just because you see 300, don't think of it as, oh my God, it's so much money. Instead, think of it as it is going to be very hard to, one, pass the account, and then two, get a payout on the account. For example, 25K, you only need 1.5K to pass the account, and you have a drawdown limit of 1.5K. 50K, you have a 3K profit target with a 2.5K drawdown limit. 100K, you have a 6K profit target with a 3K drawdown limit, and you might have already noticed by now, your profit target is going up significantly while your drawdown limit is barely going up. So the higher your account sizes, the lower drawdown limit you have and the higher profit target you have to achieve. 150K, you have a 9K profit target with a 5K drawdown limit. I hate the fact that it's moving 24/7. 250K, you have a 15K profit target with a 6.5K drawdown limit. And then 300K, you have a 20K profit target with a 7.5K drawdown limit. Now looking at the ratio with a profit target to drawdown limit, a 25K is the easiest to pass and easiest to get a payout with because your drawdown limit to profit target ratio is a 1-to-1. Meanwhile, a 300K is almost a 0.3-to-1, okay? Now, these guys almost always have an 80% sale to a 90% sale, so you should not be paying full price for these plans. Where is it? Right here. You should not be paying $397 per month. You should not be paying $187. Instead, you should be paying $187 times 0.2. You should be paying $37 per account. And then they have an $85 activation fee either for a monthly or a lifetime. The lifetime one really depends on if they're doing a promo or not. Usually it is $150 for the lifetime on a 50K and a 25K. And then the higher account size that you go for, the higher the lifetime account fee is. But if you're doing a monthly fee, it is always going to be $85 per month, no matter your account size. Either it's a 25K or a 300K. Tradeify is one of the most unique ones out there because they have, boom, 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 instant funding. It is called Lightning Funded, and basically they give you a funded account for a fixed price. You don't have to do any evaluations, do some nonsense, try to get to some profit target, and then once you finally get to that profit target, you have to pay more, and then and only then do you have access to a funded account. Instead, with this, you have access to a funded account with a one-time fee. They also do have evaluation options. So a growth and advanced account, they give you an evaluation option. One thing I forgot to mention is with Apex, they have trailing drawdown. What does that mean? Let's say your account P&L is going up like this. okay? It goes a bit lower. Let's say you are at 50K right here, and up here you are at 51. Let's just say 51. Okay, for intraday trailing drawdown, it takes the highest your account balance went up when you were in a position during the day. So because you are up and your account balance was at 51,000 at a given point in time, your drawdown limit and the peak balance is dependent on this. So it would be 51 minus 2.5K because 50Ks have a 2.5K drawdown. Now with end of day drawdown, it looks at this exact same number, but at the end of the day instead of trailing. So let's say you're in a position, let me get rid of this. Let's say you're in a trade and then it goes higher and you're at 51. You might look to close that position and deviate from your plan because of that trailing drawdown that is trailing intraday. If it is trailing end of day, you might be like, okay, I have till the end of the day. Whatever my account balance is at the end of the day, that's what it will look at. Let me hold my trade and let it play out. So once it's at 51, you might possibly take it off right here at 50.8, thinking, hey, I captured $800, but now you only have 2.3K because your peak was 51. And then it goes higher to 52 or 53, and you could have passed the account in a single trade, but instead you took it off for an $800 gain because you were too scared for the intraday trailing drawdown to kind of get you. Because once it's at 51, your trailing drawdown limit goes from 47.5 because it's taken it from the 50K to 48.5 because now it's taking it from 51K. And then you're thinking, if it goes down to 58.5, you lose that entire account. You don't want to lose it, blah, blah, blah. It just messes with your head. So if you are a beginner trader, look for end of day drawdown instead of intraday drawdown. And with Apex, they have intraday drawdown. I would not recommend it if you are a beginner. Only if you are advanced and you know how to trade can you truly make a lot of money with Apex. Because Apex is the only firm throughout all the ones I will mention that give you access to 20 accounts at a given time. So you can have 20 50K accounts, you make $1,000 on each of them, you make $20,000 from one single firm. Now, why did I say that? On Tradeify, we have a growth account and an advanced account. With a growth account, we have end of day drawdown, and then an advanced account, we have intraday drawdown. Now, the advanced are cheaper, the growth are a little bit more expensive. So if you don't really know how to trade and you are a complete beginner, then you don't really want to go for advanced with intraday drawdown because they're the same as Apex. They can really screw you. Ideally, you want to be doing end of day drawdown. Now, my funded futures. They have 3 account types: Scale, Core, and Pro. I don't know anyone that trades the Pro accounts. I've only seen Core and Scale. With Core, it is super beginner friendly because it has end of day drawdown, a $2,000 drawdown limit, 3K profit target, and you don't pay an activation fee. So your all-in cost for a potential funded account is $77. I forgot to mention, Tradeify has an activation fee of $125 on the advanced account and then $0 for the growth account. Now the Scale account is very, very similar to the Core. You can see it's almost the same, right? Like boom, boom, boom. The difference is payouts. With a Scale account, you can take out more money compared to a Core account, which you are limited to, I believe, $1,000 or $1,200 per week or bi-weekly. And then the Pro accounts, you get access to, I believe, a 100K payout request cap. You should only do this if you are a consistently profitable trader. In my opinion, do not do this if you are starting off. And then funding ticks, you can scroll down. We have a 1 account, Pro Plus, and 0 account. For a 1 account, we are looking at $112 per month for a 25K. And then 50K is $177 per month. We do not have an activation fee. Our daily loss limit is $1,000, but our maximum loss limit is $1,500. Now, this is trailing end of day instead of live intraday. And your profit target is 4,000. Now, this is very, very high. I would not recommend going with a 1 account on a 50K. I forgot why you would go for a 1 account. In my opinion, I have never traded a 1 account, but don't go for that. For the Pro Plus account, we are looking for a $2,500 profit target with a 2K max loss. And then you need a 3 minimum trading days with a 40% consistency. What does that mean? Basically, 1 trading day cannot account for over 40% of your total profits. So because you have a profit target of 2.5K, one trading day cannot equate to over 40% of 2.5K, which is $1,000. And then for a 25K, we have a 1.5K profit target with a 1K drawdown limit. And then for a 100K, we have a 6K profit target with a 3K drawdown limit. Now the 50K is 125, the 25K is 99, and the 100K is 200 per month. And with all these firms, they all give discounts, so you are not paying the full price. So make sure you use code MO for the best discount available on Funding Ticks, My Funded Futures, Tradeify, or Apex Trader Funding. At the time of recording, it is 80% off, but when I upload it, it could be 90 or still 80 or even 71. It's usually never below 71% off, and if it is, do not buy an account from them. You should only be buying them if they are either 80% off or 90% off. Simple as that for Apex. Tradeify, they give out bigger discounts from time to time, but only during like big holidays, right? During Christmas, Thanksgiving, 4th of July and all that. My Funded Futures does the same thing. And then Funding Ticks, they recently just did a 35% discount because they paid out $5 million to their customers. So 35% of 200. What's the math? I believe it's $130 maybe for a 100K, and then I'm not doing the math. You guys know. So if you do not have the capital starting off and you have the skill set of trading, you can look to trade these firms because they give you the biggest return on investment. Let's say you spend $100 for this 50K account and then you make $5,000. You can withdraw half of that profits, so 2.5K, and your all-in cost for this account was $100. That's amazing. And then you can do this with every single firm out there. And once you start doing that, you can look to scale your account and really fund your own account at that point. Or what you can do is you can watch the prop firm video I made so you can learn to scale these prop firm accounts, because I give out a lot of information on that video and it is over 30 minutes long. I don't want to make this portion of the video too long because not a lot of people will be trading prop firms. So if you are interested in that, make sure you click the link over there or click the link in the description, or just go into my channel and watch the video that is titled How to Actually Trade Prop Firms, 2 million in funding, something like that. And that is how you look to scale your capital with the skill set of trading. If you do not have the skill set of trading, look to demo trade first. Once you are profitable for 3 months, then you should look to buy a funded account, look to scale that. Once you make a payout, then buy more accounts. You should not be going into this first day thinking, yo, let's buy 10 150Ks on Top Step. Let's max out on Apex, max out on Tradeify, all on my first day because I'm trying to make the most amount of money. You're cooked. Instead, demo trade first. Then once you're profitable with demo, then you can go to a funded account, start small, get a payout, use that payout, reinvest, continue that cycle, and before you know it, you're making 10K per month. And now for the psychology aspect of this video. This is going to be a very important section, but I doubt a lot of people are going to watch this. So if you are watching this, good work. You actually care about this. And it is a sign that you will succeed in this career. Now, starting off, I will say trading will be the hardest thing you ever do. It is something where you have to master your mind, and it takes so much discipline and hard work to achieve that goal, to the point where 99% of people, the reason they're unprofitable is because they fail to fix what is in here. So going into it, let's first have proper expectations. This is not a get rich quick scheme. You will not make $1 million your first year. I'm going to be honest, you will likely be unprofitable your first year. You will likely spend the first year or two struggling hard. And this is just part of the journey. A lot of people get into day trading thinking that it is easy money. But funny enough, it is the hardest way to make easy money. Because now that I have the skill set to just click a button and make money, sure, it's easy. But it took years of hard work to get into this. Think of yourself as a professional boxer. On the night you need to fight, let's say you are headlining a pay-per-view event, okay? And that night, you make, let's say, $100 million, for example. You did not make $100 million from one single night because you're only fixating on that one night. It really took you 3 months, 6 months, years to get to your level of making that $100 million in that one night. And that's very, very similar to trading, because you will see profits on social media everywhere, and people will make 10,000, 100,000 in a single day. And you're like, damn, but you're not thinking what went into it. What was in the back end? And then because this person makes 10K, 100K in a single day, you might think, yo, I need to make this money to really feel like I'm actually making progress in this industry. But instead, the person that did make 10 or 100, whatever, however much he made, he's been doing this for 10 plus years. Okay? And you're comparing yourself to someone that's been doing it for 10 plus years. Let's say you're in year 1 or 2. Is it proper to compare yourself to someone that's been doing this for 10 years? Likely not. So you shouldn't compare your year 1 or your day 1 to someone's day 1000 or year 10, whatever. What you have to do is have proper expectations going into it. It's going to be hard. It's going to be difficult. But if you get to the other side, you will have an income generating machine that can literally print wherever, whenever. Not whenever, because let's say you have certain time periods to trade, but wherever. You will have complete location freedom and time freedom, because let's say you don't want to trade today. You don't have to. You don't have to answer to anyone. And let's say you want to over leverage and over trade. You can do that as well, because you don't have to answer to anyone. So it's like a double-edged sword. If you do the second option, you can set yourself back years in a single day. That's the scariest part about day trading as well. I've seen, me personally, people put in years of hard work, and then in a single day or week, those years of hard work is erased. Okay? I have a story of one of my friends' friend, and he scaled a 100K account to around $3 or $5 million. And then he blew it up in a single afternoon. Yes, $5 million gone in a single afternoon, not a single day, afternoon, which is around 2 to 3 hours. I want you to fully grasp what you're getting yourself into. This is going to be very hard. You need to be disciplined. And if you are not, this is what will happen to you, and the market will happily, gladly welcome you with open arms and take your money. This isn't an industry to get rich quick, and it will be the hardest thing you do. But when you overcome that, you will have the skill set that no one can take from you. You don't have to answer to anyone ever again. Now, with this in mind, I want you to start having a probabilistic mindset. You should start looking at things in a matter of probabilities only, because this is what a professional trader does. Nothing has a 100% certainty. So let's say you enter into a trade, don't think you are going to win and don't think you are going to lose. Accept the probabilities of winning and losing. Now, right now, I can go long or short, flip a coin, and the probabilities of me winning are 50% and the probabilities of me losing are 50%. If I'm able to favor the probabilities to my direction, where I have a probability of winning, let's say 70% of the time, and let's say the times I do lose, I only lose 1R, and then the times I win 1.5, 2R, 3R, whatever. That increases profitability because I'm thinking in probabilities. When you start thinking in probabilities, you accept the risk that is involved with it. Because you know, out of 10 trades, let's say you have a 70% win rate, you will win 7 out of 10 of them. And if you don't, let's say you win only 5 out of 10, you know that this is an anomaly and your data set is too small to have that 70% win rate right now. But when you get closer to 100 trades, it will get closer to that 70% win rate and 70 wins. And when you start thinking of it in a matter of probabilities only, you detach yourself from the outcome. Think of a casino. What does it have? It has an edge because probabilities are skewed in their favor. So, more times than not, you know, over a long period of time, the casino will always win, because probabilities are skewed in their favor. So if you apply this same concept in trading, you will stop getting emotional on losses, losing streaks, because you know this is just probabilities. And over a long period of time, you know that you will be profitable given you have a profitable strategy. And that's what trading truly comes down to. It's your ability to stay in the game for the probabilities to play out. So let's say you're supposed to take 100 trades, you lose your account in 10. In the 90 trades that you didn't take because you lost your account, With those, if you have a profitable strategy, you probably would have made money on those 90 trades than the 10 you lost over here. So when you start thinking of it in an aspect of longevity and probabilities, you stop caring about one trade being a loss, 2, 5 trades being a loser. It doesn't really matter because you know over 100, 1,000 trades, probabilities are skewed in your favor if you have a profitable strategy, of course. And this is the mindset you need to incorporate. And another way of getting rid of the attachment to the trade that you're currently in is fully accepting the risk you've put on the table. I've seen a lot of people get into trades not willing to accept a loser. I want you to accept the risk you place onto a trade before you even take it. So in your mind, I want you to think you've already lost that money. Let's say you are risking $100 for this trade. You will think, I already lost this $100 when you place that buy or sell position. When you do that, you stop caring about the outcome of the trade because in your mind, psychologically, you've already lost that money. It's not your money anymore because it's in the market. Doesn't matter what happens. And when you have this mindset of you don't care about the outcome, you are less emotional during the trade. And when you are less emotional during the trade, you manage it better. You take better trades in the future. And when you have this and you consistently do this, you start taking good trades. You start managing good trades. And when you have a good system behind it, it's just a plethora of high probability trades, good trading activities. And this is what I want you to incorporate as well. You need to accept the risk that comes with every single trade. Before you place a trade, I want you to accept the risk that you place. If you are nervous in a trade, that means you haven't accepted the risk. Find a number that you're comfortable with. So let's say it's $10. Don't laugh at yourself risking only $10 because that 10 can easily become 100,000, 10,000 of risk in a couple months. So what I want you to do is when you are nervous in a trade, risk less. Let's say you risk $10. Will you be emotional during that trade if you are risking $10? Likely not. Find a number that you are not really emotional on, that you don't really care about, and that's in the middle ground of you're still taking good trades. Funny enough, when we start risking such little amounts, we stop caring about the quality of the trade that we're in. Because we're just like, it's just $10, it's just $5, whatever, I don't really care, let me just enter into the trade. So this is why you should have a middle ground of you care about the trade, but also you don't care about losing the trade. You feel me? And then your activity and your homework will be to gradually increase this. If it is $25, gradually increase it to 40, 50. How do you feel when you are in a position when you're risking $50? If you're anxious, then look to lower your risk a little bit more because let's say you're not nervous on 25 and you are on 50, let's go to 35 or 40. Try to find a middle ground and gradually turn the knob. Gradually increase your risk because you won't go from $10 of risk to $1,000 overnight. What you need to do is gradually increase that and get your mind comfortable with risk. Get your mind comfortable with losing, because when you're comfortable with losing and you have risk on the table, then you can start looking to scale your account further given you have a profitable strategy. Now, two very big emotions in trading are fear and greed, and they are going to be very, very hard to overcome. The way to overcome them, well, fear is, there's one version of fear of missing out, and then fear like when you're in a position and it's going down hella. So let's talk about the first one first. Now, when you have FOMO, aka fear of missing out, you are thinking of the market in a way where you should be in a trade. You want to be capturing a move that is happening. Let's say we go higher and we're going parabolic. You're thinking to yourself, I should be in this move. And a way of increasing your FOMO is trying to think where you can get in on this move or how much money you could have made on this move. What I want you to start doing is, with the strategy that I've given you, backtest it, find rules for it. If you don't know any rules for it, it'll be linked down below. Like I have a introduction to my HyperFlow indicator and strategy video, and I go through all the rules that you should be looking at. And if a trade does not align with those rules, you are unable to take it. No matter what. It doesn't matter if it goes parabolic, like up or down. It does not matter. If it does not align with your rules, you cannot take it. So this is where discipline comes in, and you need to be disciplined enough to see a trade that is triggering that doesn't line up with your rules. And when it does trigger, you have to be disciplined enough to not take it. And this will 100% get rid of your FOMO, because if your strategy is not triggering, if your model isn't triggering, you cannot enter into the market. And if you are entering into the market, note that, journal that, and then note that you're entering into a trade that isn't your setup. So you are breaking your rules, trying to get into a move. And then number two, you're allowing FOMO to, I guess, control you. I want you to think of it like this. You watching this, the person, your conscience, you are what control your body and your mind. Like this hand, for example, I am controlling this. The way people spiral and the way people lose a lot of money is when they start having their emotions control them instead of their actual conscience. I can click a button right now and risk my entire account. Will I? Hell no. So the person that is watching this video, your consciousness, I want you to control when a trade can take place. I don't know if a lot of people will understand this, but I'm trying to think of it in a way where my brain thinks of things. And the way it thinks of things is, I am here. My consciousness is what allows me to move my hand, right? Is what allows me to be happy, to be sad. And it is also what allows me to make decisions. Your consciousness is the only thing that is accountable. You cannot allow your emotions to control your consciousness and your body. There are times where it can occur. If you are super drunk, if you're super happy, there's a feeling of euphoria, super sad, you're depressed. If you have any like huge emotion, there's a chance where your consciousness is put into the back seat and your emotions are what is driving the car. So I want you to always be conscious of your consciousness, if that makes sense. When you place a trade, who is placing it? Is it you or is it the FOMO? If it's the FOMO, you're dead ass allowing your own emotions to control you. That's kind of bitch made, I'm gonna be honest. Like, you dead ass right now. And when you start thinking of yourself and decisions like this, every decision that can ever occur now is and can only be done by you. And when you start thinking of it like this, you cannot blame anything else, anyone else, because when you make a decision, your consciousness made that decision. And I want you to have your consciousness follow your rules 100% of the time. Ingrain it in your subconscious or your regular mind. You can only follow your rules. If you start to deviate from your rules, you know that your emotions are driving the wheel. You cannot have your emotions take trades for you because they will be terrible trades. I've seen it myself where I take a trade after a loss, I start revenge trading, and I lose the entire account because I'm allowing my emotions to trade for me. Instead, if I allow my consciousness to trade for me, I'll be following my rules. I'll be disciplined. I'll have good risk management. I'll be taking proper positions. And in turn, that will put me leaps forward to profitability, because if I have a system that is profitable, it will make money no matter what. If I follow the rules, if I'm disciplined and my psychology is in check, my risk management is in check. When you have these things, profitability isn't an if statement anymore. It's literally, it will happen. And you just need the probabilities to start playing out in your favor for that profitability to occur. Simple as that. And that is when you will truly start thinking like a professional trader. Wow, this video was long, and I think I can finally take off my glasses. You guys can see my real eyes. Now that you're at this part of the video, I'm going to tell you guys that should encourage you to continue on this journey. And it is that 99% of the people watching this video have not made it this far. They have clicked off this video super early on, and the fact that you're even watching this video shows how determined and hardworking you truly are and how much you care about succeeding in day trading. So with that, firstly, I just want to say I am proud of you. You have what it takes to become a profitable trader. And it just goes back to that statistic that I said in the beginning of the video, that 98% of day traders fail. And the reason they fail is not because of a lack of resources or IQ. It is because they don't have what it takes to do a task for an extended period of time and they quit. It is said that 80% of traders fail and are unprofitable in their first year of trading. Out of the 98% that fail in total, 80% quit during their first year. And when the second year starts, there's only 18% of unprofitable traders still going through. And during that second year, let's say another 50% quit. When the third year starts, only 9% of unprofitable traders are still left. Each year that goes by, the amount of unprofitable traders that continue trading significantly decrease to the point where it will go to zero. This means after a certain period of time, there will be no unprofitable traders that are still trading. Every single person that has been doing it for this period of time is profitable. And that is the worst case scenario for you. By the third or fourth year, the percentage of profitable traders outweigh the unprofitable. So the odds are stacked in your favor if you continue to do this for an extended period of time. Granted, you put in the effort and are consistent, which is why I say you only fail if you quit. And the fact that you have watched 4 hours of this video, taking notes, I hope, deliberately putting in the effort to become better, shows me that you are part of the statistic that will succeed. Out of every 100 people that watch this video, only 1 or 2% of people will actually hear the words that I'm saying right now. And guess what the statistic of becoming a profitable trader is again? Now, the reason I can say this so confidently is because I was in the same position as you right now. I was unprofitable when I started. I put in the work. I hated everything that I was doing and I wanted to quit so many times. But guess what? I didn't. I put my head down and focused solely on the process of becoming a better trader and becoming a profitable one. So trust me when I say this, the fact that you're even watching this far into the video tells me that there is a very, very, very high chance that you are part of the 1 to 2% statistic that will succeed in trading. I can almost guarantee that this video will be one of my most watched videos of all time. And I'm also guaranteeing a lot of people will have clicked off this video 30 minutes, 1 hour, 2 hours into this video, not finishing the entire video because it is too boring. And that is your competition. And the fact that you're watching this far into the video right now tells me you have the same hunger in you that I had when I was unprofitable. So I'm talking to my younger self when I say this: keep this journey and keep working hard. Now, like I said, because you have made it to the end of this video, you are likely unprofitable, but that's not a bad thing because you have the work ethic and discipline to achieve profitability. And you actually care about this enough to succeed in this industry. This video has given you absolutely everything that you need to become profitable. No one else cares about you as much as I do with the amount of information I have given you in a single video. And this video should have built a proper foundation that you can build upon to become a profitable trader, which is the most important aspect to building a house. You need a proper foundation, and without that, the entire thing will crumble. The entire goal of this video was to give you the proper framework to go from unprofitable to profitable. Now, there's going to be certain things out there that you need to experience yourself to achieve this goal, because I can tell you everything you need to know, but until you truly experience it yourself, you will not fully understand the lesson that I was preaching. Now, you will have to make mistakes, but the mistakes won't be as big as the ones you would have made had you had not watched this video. And again, this journey is extremely long. It's not a short journey of profitability, and it will take a year or two to achieve profitability. If you don't want to spend 2 years trying to find these mistakes, experience them yourself to become a profitable trader, and you want a fast track to profitability, that is exactly why I have a one-on-one mentorship that I'll give you the opportunity to hear about. I only have one big regret throughout my entire day trading journey, and it is not having a mentor when I started. The reason I say this is because I could have cut my journey of profitability from 1.5 years to half that time had I had a mentor. And instead I had to learn it all myself. And it was super difficult because I had to find out what I was doing wrong and fix that, and also find out what I was doing right and carve my path to becoming a profitable trader myself. And it's like being stranded in a desert. If you have someone that knows the exact way to get out, you'd want to follow them instead of trying to find your own way out. So with that being said, I do not want you guys to go through the same journey that I went through. It was extremely difficult and lonely. And there's a reason why I'm not saying this at the start of this video. If I wanted more people to know about this message, I would have said it at the start of this video and more people would sign up for it. But I don't want that. Instead, I want to help people that will actually put in the work and are actually disciplined, that actually give a shit about this, compared to the people that probably left 30 minutes into this video. And really, this mentorship is only for people that have that work ethic and have that drive to succeed. It's not for anyone else, because the mentorship isn't going to make you profitable the second you join, but instead it'll give you a proven path that you can follow if you put in the hard work that is required to follow it. I can give you a map where treasure is located, but if you are not willing to go through the journey to get to that treasure, the map is meaningless. And the fact that you guys have made it to the end of this video, I can almost guarantee that you guys have what it takes to become a profitable trader, just like how I did when I first started. I had to take years out of my life that I wish I could get back to master the skill set, and you guys don't need to go through this as well. And that's the greatest thing about this space. Before, when I started, there weren't that many people that I would gravitate to and I would willingly want to learn from. And that's the main reason why I did it all myself. And you guys are low-key spoiled with how many people you can go to learn the skill set and get feedback from. The best part about it is that you have access to us almost every single waking minute. So if you have a question about something, you can get that answered the same day. You have direct access to us every single day. So you can ask, hey, I took this trade, what was wrong with it? And we can pinpoint exactly what was wrong with it, and then give you that information in a fraction of the time that it would take for you to find that information yourself. And that's how growth can really come to you guys, because let's say you have a lesson that would have taken you a week to learn by yourself. You learned that within an hour with the proper guidance. Then you learn another lesson the next day, and then the next day, and a week goes by. The time it took you to learn lesson number 1 by yourself, the other version of you with a mentor would have learned 5 lessons with the same exact time, which would have given you exponential growth. And the fact that you've gone this far tells me that we can be a huge help to your success. Because if you weren't, you just wouldn't be hearing this message. All of this information out of this 4-hour free course was to help you guys, and that's it. So what I want to do, which is different from everybody else, is to use that information that you've learned and go apply it correctly and solve the personal mistakes that you guys currently have. And that's what no one else will do. They will give you a course that you paid for, and they will say, have fun, and you will never hear from them ever again. And if they do promise some time with you, it is super half-assed and not personal at all. How does that help you learn and digest information? The fact is that everything can be learned on the internet. The internet is a huge place. You can use ChatGPT or YouTube to find the same information over and over again, but what they can't give you is years of profitability and personal mistakes that I used to make, and probably you guys are making right now as well, which I have the exact solution for. And that is what my mentorship can bring to the table for you guys. The mistakes I was making back in the day and the mistakes you're making right now, these YouTube videos cannot give you the solution to these problems. There's only a certain level of information you can get on YouTube. I would say it is only around 80% you can learn just by watching content. The other 20% is learned through mistakes and practical steps that you have to do yourself. And that is where I truly want to help you guys. Who can solve the problems in this process? A person that has put in 10,000 hours of hard work and has gone through hardship to get to this point, or a YouTube video that cannot even connect to the exact problem that you're facing. Because I can almost guarantee you with certainty that the mistake that you're making right now, knowingly and unknowingly, I've done it before. And that is why I want to help you. I want to be there for you because no one was there for me when I was in the same position you are in right now. And I do not want anyone to go through what I did. Cause bro, that shit was rough. Like, I do multiple calls per week addressing the issues regarding trading today. If you are in a trade or you made a mistake that day, you can go and say, hey, I made a mistake, and get feedback that same day. You don't have to go through some bullshit, book a call, and you have to go through weeks or months just to find an open slot. But instead, you're like, hey, I made a mistake today, and you get a complete breakdown on how to address these problems and how to fix them to see consistent growth in a short period of time, compared to searching for a YouTube video for weeks or even months to solve one mistake. The person that gets their issue solved in a single day and then gets another issue and get to solve the next day and does that for a month straight can get access to the same information it would take someone else years. I'm being so dead ass. It would take years to acquire the same information if they do it all themselves. One thing I will say is that time is the greatest currency ever. You can never buy it back. So if there is something out there that can help you save time and get you to a destination faster, it should be a no-brainer to someone that is hardworking and determined to succeed. So with that being said, if you guys do want to be mentored by me, click the link down in the description. Regardless if you join the mentorship or not, I hope you learn a lot from this video and you take practical advice and you actually apply this information. This information means nothing if you do not apply it. And I hope this video cut your journey of profitability to a half or even a quarter. My main goal with this video is to dookie on every single other trading influencer out there that is trying to give you information and is trying to have you pay for this information. So I gave you all of this for free. You deserve this information for free and you deserve the same probability to succeed as someone else with this information. And I can guarantee you, you will not get better information about this anywhere but this channel. I genuinely love you for making it this far into this video, and I hope to see you in the statistic of profitable traders. So with that, I'll see you in the next one. Later.